cooperation with some Portuguese financial supervisory authorities and with international scientific partners, in particular, the European Banking Institute, EBI, in whose network the University of Lisbon has been admitted, but also with the Florence School of Banking and Finance and the Berlin-based Financial Risk and Stability Network. But for cautionary reasons, in the spirit of transition to what we all hope may be post-pandemic times, we hold the conference only in online format, which allows us to combine in slightly different time zones a Portuguese audience and a much enlarged international audience. And again, in this context, English will be our main working language today. Let me start by thanking our scientific partners within a program of cooperation that is established anew every year on the basis of a working program that we address annually to some financial supervisors, bearing in mind the specific content of the initiatives we envisage for the year. As regards 2021, I'm referring to the Bank of Portugal and the Portuguese Securities Commission, CMVM. We thank them heartily for standing by with this scientific project in difficult pandemic times, which conversely, I would dare say, require more and more critical thinking about the financial sector and its contribution to the economy in general. In the case of Banco de Portugal, or the Eurosystem, a key institution in the Portuguese economic and social fabric, commemorating this year 175 years, we have the privilege to count with an important keynote address of Governor Mário Centeno this morning, and with a much relevant intervention of Vice Governor Luís Máximo Santos opening the afternoon sessions. We are indebted to both of them for their support and their time. Allow me a very special word this year concerning the Portuguese Securities Commission, CMVM, and the reason for that is twofold. On the one hand, CMVM is commemorating its 30th anniversary, which is a momentous date, and I would like to refer here to the great international conference to be held by CMVM jointly with IOSCO this next November. On the other hand, the chair of CMVM, Gabriela Figueiredo Dias, with whom I have the great privilege of sharing this opening session, is now in the concluding stages of her mandate at CMVM. And I make a point of emphasizing here a major contribution to this challenging endeavor, which is financial supervision. She has been epitomizing a demanding and, at the same time, proactive stance in terms of financial supervision in a true spirit of independence, which is also the cornerstone of the public mission of a supervisor. And it is certain that she will pursue this analytical track record in any mission whatsoever she may embrace in the coming future. Well, coming now to the core of our conference, entitled The Financial System and the European Economic Recovery, and with the subtitle Overcoming the COVID-19 Systemic Shock and Current Challenges of the Banking Union and of the Capital Markets Union, this encapsulates clearly, I hope, our program for today. In a nutshell, in the wake of the game changer represented by COVID vaccination, we purport to critically discuss the risks and opportunities experienced by the European Union financial sector as a key factor in overcoming the COVID crisis and spearheading at the same time a solid and widespread economic recovery. Within this very particular context, we in Europe, in Portugal and in Europe in general, are clearly in a major critical crossroad. I would say that to perceive how we overcome such crossroad, we should follow how we'll be moving and how we'll be evolving the angles of a key legal, political, and economic triangle. This triangle involves, one, the prospective reform of the European Union fiscal rules, as somehow anticipated by the Commission a few weeks ago, stating that it will explore options to improve the Stability and Growth Pact by the end of 2022. And it involves, two, the completion of the still unfinished European Banking Union, and three, the pursuit, but here I would dare say the reinvention of a true European Capital Markets Union, as envisaged precisely a year ago in the updated CMU plan, marking a significant progress, but still rather vague in its contours. And I would say that if vagueness might be praised, as William James considered in philosophy and psychology, perhaps it should be avoided in these fields. Allow me at this stage some brief words about context in this last quarter of 2021, and what it means for the critical balancing of risks and opportunities as regards the financial sector and its overall contribution to the post-crisis economic recovery. Here, it is pertinent to refer to the recent Joint Committee of ESAs, EBA, ESMA, and IOPA report on risks and vulnerabilities of the European Union financial system, which has been just released on the past 8th of September. In this report, the three ESAs, on the one hand, acknowledge that over the years since the COVID-19 pandemic started, the financial sector has largely proved resilient in the face of its severe economic impact. In other words, the financial sector has met so far the test of financial stability in face of an exogenous shock, which did not spill over to a financial sector crisis. But on the other hand, the three ESAs pointedly stress that some significant risks, uncertainties, and vulnerabilities persist and require attention. Among other aspects, in connection with the uncertainty of expectations for economic recovery and the uneven nature of such recovery among member states, the three ESAs point out that financial institutions should continue to be prepared for a possible deterioration of asset quality in the financial sector, in spite of the improved economic outlook, and particularly in the case of banks, these may need to withstand possible increasing credit risk losses as a consequence of expiring paying moratoria and other public support measures. So in a nutshell, although the new European architecture of financial supervision put together after the last financial crisis, even if incomplete and comprising the ESAs, the Single Supervisory Mechanism and the Single Resolution Board, allowed this time a range of timely, supranational, fiscal and prudential exceptional response measures, avoiding the worst, the overall context remains fragile, prone to uncertainty, and require an extremely well-calibrated phasing out of the exceptional crisis measures. And accordingly, financial stability and a consistent economic recovery, which emerges as an opportunity to the European Union as a whole, require the completion and consolidation of the European Union architecture of financial supervision and an ambitious reform of European Union fiscal rules, not merely a return to the status quo preceding the COVID crisis. Well, on this note, it is appropriate to come back now to the crucial legal, political, and economic triangle that the European Union should sort out in the coming months and roughly in the next 2 years, 2022 being the most crucial year in this respect, and to consider the first angle of such triangle on reform of European Union fiscal rules. We can already anticipate here a fierce debate between a pro-fiscal stability group, stricto sensu, formed by a group of more fiscally conservative member states, and several groups of member states and stakeholders advocating a revised framework of European Union fiscal policy with extra flexibility and new permanent instruments to balance fiscal sustainability with the need to support effectively the economic recovery. How much flexibility and what type of balance between these different goals is something that will have to emerge from the political, economic, and legal discussion in this domain. But this will represent a most crucial discussion, since monetary policy may not be able to maintain the level of support to the economy that reached its peak during the bulk of the COVID crisis. And as we all know, very recently, the ECB stated the net asset purchases under the Pandemic Emergency Purchase Program, PEPP, can continue, but at a more moderate pace. And while the ECB President, Christine Lagarde, paraphrasing Margaret Thatcher, stated that the lady is not for tapering, meaning that the ECB is prepared to continue to play its part, inflationary tensions, including those arising from the energy sector, may at least, and in the more optimistic scenario, contribute to a more moderate contribution of monetary policy measures to the stimulation of the economy. On the second angle of the European Union triangle that I mentioned a while ago, and which concerns banking union, we have to retain here the significant June statement of the President of the Eurogroup, quoting exceptionally, "We have made progress, we need to make progress, we will agree a work plan, but it will take a bit more time, and we will be returning to this later this year." We should note here the abundant use of the future tense in this last sentence, and the fact remains that the Eurogroup so far has not met the test of reaching an overall agreement on a specific roadmap to complete the banking union. In this context of an incomplete banking union, the good news for the banking sector is that the results of the recent stress test exercises are indicative of increasing banking sector resilience and suggest that the euro area banks could cope with further adverse economic developments. The less good news is that the full impact of the COVID shock has yet to materialize on banks' balance sheets, and this requires both, as already mentioned, an extremely careful calibration of the phasing out of the exceptional crisis measures for the banking sector, and, as the chair of the single supervisory mechanism, Andrea has put it suggestively, a proactive, dedicated banking supervision credit risk strategy, mapping ahead supervisory expectations and tackling in advance any potential problems of delayed, non-performing loans, NPLs, recognition and resolution. This can be done through incremental measures of supervisory convergence, but at some point, the vicious circle between, on the one hand, progressing on real banking integration and truly common, not merely harmonized supervisory tools, and on the other hand, developing ex post public risk sharing mechanisms, namely in the form of deposit insurance and also supranational financial support to resolution measures in extreme cases, is a challenge that has to be met and cannot be postponed indefinitely. Considering now simultaneously the second and third angles of our European Union triangle, involving banking union and CMU and its interaction, we should, on a more positive note, acknowledge the potential for progress arising namely from two recent public consultations launched by the Commission. I am referring here, with no time available to enter into the details, we shall do it during the conference, to the consultation concerning the review of the crisis management and deposit insurance framework, and to the consultation launched as part of the new CMU action plan on European Union supervisory convergence and the single rule book. This latest consultation covers a very wide range of matters which were pondered and discussed in the so-called 2017 ESA's review, culminating then in the ESA's revision in 2019, including concrete measures to achieve progress on supervisory convergence, the adequacy of ESA's governance, possible additional direct supervisory powers for the ESAs, particularly ESMA, involving the delicate debate between further centralization or the sufficiency of current tools to achieve supervisory convergence. For instance, enhanced peer review and others. Allow me now to conclude some very brief words to flag the areas we shall be covering during the day. After this initial session, which will comprise an intervention of the chair of CMBM, addressing a potential post-pandemic change of paradigm for the financial system, we shall have a keynote address by Governor Mário Centeno, focusing on the challenges and opportunities for the financial system in the context of economic recovery, and we shall move forward to a first panel with the chair of EBA, the interim chair of ESMA, and the vice chair of the Single Resolution Board, plus Christos Gortsos of EBI, which will provide, I think, an excellent window to discuss the progress and prospects of the banking union and capital markets union. And the morning will be concluded with a second panel reuniting Luis Garicano from the European Parliament, Thorsten Beck, director of the Florence School of Banking and Finance, and Vitor Constâncio, with his insight as former ECB vice president, that is bound to address the wider reform of economic governance of the European Monetary Union, putting it in context as regards consequences for the financial sector. We'll start the afternoon zooming to banking market conduct supervision and the challenges of an integrated approach to supervision, combining its prudential and market conduct pillars, and with an address by Vice Governor Luís Máximo Santos, to whom I thank all the continued support to CIRSF. We'll close the substantive proceedings with the last panel, reuniting Harold Benning and Michael Taylor, taking a wider view in order to discuss challenges to financial stability worldwide, confronting the situation in the European Union, the United States, Asia, and China, and in this last case with some possible topical remarks of Michael Taylor about the crisis of the Evergrande Group in China and its potential consequences. Let me close rapidly with an old Chinese proverb. Don't be afraid to get old, be afraid to stand still. While European integration is going deep into its sixth decade, and after a unique, challenging economic crisis, the European Union cannot and should not really correspond to a mature entity with a complacent view that the new instruments of economic governance created in the course of the last great financial crisis have allowed it to endure and resist to the COVID crisis. The European Union has to move forward to a new level of overall economic governance with financial stability at its core, based on new and creative equilibria and overcoming, with a realistic balancing exercise, divergent views about that economic governance. I thank you for your attention, and I wish you all an excellent conference during the day. I will now give the floor, thanking her for her presence and the continued support, to Gabriela Figueiredo Dias of CMVM. Thank you.
Thank you very much, Luís. Can you hear me? Okay, thank you. So, thank you very much, Luís. Good morning and a warm welcome to all attending this CIRSF 2021 conference. And before starting, let me address a very special and heartfelt thank to Luís Moraes for the warm and generous words about the CMVM and about my own contribution to the progress of financial stability. Financial supervision. In fact, this will be my last intervention at the CIRSF conference, at least as CMVM chair. And so allow me to share that it was for me an immense privilege to have been part of this financial world, or financial regulation world, in such exciting times, with so dramatic changes happening in Portugal, in Europe, and all over the world. So it is time for us, regulators, to take our responsibilities rightly and assume an active and critical role in the construction of the banking union and capital markets union, working for the economy and for all the citizens. But let me also address a heartful and grateful word to Luís Moraes for leading such important initiatives, for challenging us to reflect on the future of financial regulation, very well beyond the daily routine of supervision, for his free mind and for challenging us all the time. We need that. We need this challenge. We need this capacity of going deep into the issues. So thank you very much, Luís, for all your work and for these welcoming conferences that you have been organizing. It is a true honor for me to deliver these opening remarks in such an important event. And so thank you very much also for the invitation for this opening session. So I'm sure that our work today, as in the other conferences, will be fruitful and will shed light on how to tackle the challenges in recovering from the pandemic. And for that, we are all indebted to Luís Moraes for this remarkable conference that brings us together every year. The pandemic resulted in a systemic shock to the global economy, exposing and aggravating vulnerabilities that were already mounting before the outbreak. In fact, corporate indebtedness had reached historical highs in several geographies previously to the pandemic and is already now surpassing the levels registered in 2008 and 2009. By the end of 2019, well, before the pandemic, the IMF had estimated that an economic shock equivalent to just half the one induced by the great financial crisis would result, if it would happen, in around 50% of the G8's non-financial companies struggling to serve their debt in the aftermath of such shock. The question seems then to be, has the pandemic produced that level of shock? Well, looking at the stock market's behavior during the pandemic and as well as to the evolution of corporate spreads, both in the US and the EU, the answer would probably be negative. The answer would probably no. In fact, as I speak, several stock markets have reached historical highs. Price earnings ratios are above their long-run averages, and corporate spreads, in some cases, are even below the levels observed before the pandemic. Although these are, of course, good news to which contributed effective policy actions, this market performance might not be sustainable, especially as we start reversing the support measures. Looking ahead, it is highly likely that debt levels will remain high, that real growth prospects remain uncertain, and that we might observe significant market corrections. The recent episode with the Chinese conglomerate Evergrande that Luis has already mentioned in his initial intervention is a stark reminder of some of the risks that we face, even if its effects are, at least for now, mainly circumscribed to Asian markets. Focusing on the European Union and on the debt segment, European corporates continue to mainly rely on banking credit, and in those segments most affected by the economic freeze, the financing needs will increase as they will emerge from the pandemic even more undercapitalized. So companies will be faced with an old dilemma, which is whether to raise more debt or capital to satisfy their financing needs. In my view, there is very limited room for companies to increment further their debt levels without deteriorating their default probabilities. Furthermore, and while disruptions in the banking sector are not expected, since banks entered into the current crisis in better shape than they were in 2008, it is nevertheless likely that the discontinuation of public support measures will bring more non-performing loans, which in turn may induce credit tightening in our economies. It is therefore of the utmost relevance to affirm the role of capital markets as a viable and attractive alternative source of funding to the real economy. A growing non-bank financial sector not only brings new funding options, but also, from a macro-prudential perspective, carries benefits in terms of increased risk sharing across the financial system, as already underlined by the ESRB. At this juncture, all relevant stakeholders, including decision and policy makers, must be conscious of the critical role of capital markets in the recovery and assume their responsibilities in making it work for the economy and for the people. Being well aware of risks and vulnerabilities, I believe this could be a refoundational moment for capital markets in Europe, boosting a capital markets union that places retail investors at its core. A greater participation of retail investors is essential to deepen the capital markets in the European Union and to achieve a true capital markets union. It is a fact that the global savings rate in the European Union has increased during the pandemic. But it is also true, on the other hand, that many households lost income and some may need to increase their debts. In many cases, I'm afraid, the discontinuation of public support measures will result in aggravated financial and income differences between investors and companies. This means that without a strong economic recovery, those investors that were more impacted by the crisis faced the risk of being left behind. And for those who will be able to save, the foreseen low for longer interest rate environment calls for alternatives other than bank deposits to meet their needs. Capital markets can help in both fronts, supporting a more balanced strategy to finance companies and promote stronger growth while offering better returns for families. It is therefore essential that investors are offered adequate saving alternatives. Citizens would benefit from simple and attractive products that offer better returns and meet their investment goals, as is the case of enhancing retirement savings given the demographical challenges that lay ahead in the European Union. The Pan-European Personal Pension Product, PEP, can prove to be a useful instrument for this purpose, channeling retirement savings to long-term investment opportunities. Investment funds will also have an important role to play in this regard, as well as other segments of non-banking financial intermediation. It is also very important to grant retail investors with good and comparable information, particularly on risks and costs, and to promote increased access to qualitative investment advice while fostering their financial literacy. Summing up, financial products and their distribution should ensure adequate levels of return and of retail investor protection. There will be no demand without trust. As we speak of this distribution and retail access to different products, we cannot ignore that the pandemic exacerbated the speed of digital transition. This development enhanced the participation of retail investors in capital markets by allowing an easier and faster access to new instruments, and has been also the basis of new business models and projects that challenge conventional financial players, as well as the regulatory framework for financial markets and consumer protection. ESMA's latest report on trends, risks, and vulnerabilities wisely underlines that, and I'm quoting, "This shift towards faster digitalization has brought efficiency gains for firms and better outcomes for users of financial services, but raises new challenges for regulators, including in relation to security, data management, and competition." And it goes without saying, investor protection under the new types of relationships between clients and firms. Acknowledging, of course, benefits and risks is even more important as the increased financial pressure on households, combined with their easier access to platforms and intermediaries and dissemination of information through social media, may translate into higher risk-taking. The information to be provided to investors, the disclosure of proper warnings, and how to ensure the adequacy of products to investors are all examples of elements that should be reassessed in this digitalization context. The upcoming MiFID review could be a relevant, timely opportunity to do so, but also recent legislative proposals as the ones related to markets in crypto assets, the so-called MiCA, and to the safeguard of digital operational resilience, the so-called DORA, are also important steps, providing a relevant basis for harnessing the benefits of innovation while containing the associated risks. In this effort to ensure investor protection in this accelerated digital age, we must use innovative solutions, taking advantage of lessons learned during the crisis, namely regarding simpler and more effective ways to offer old and new investors the information they need and to ease the regulatory burdens on firms. In parallel, fostering companies' and citizens' financial competence is crucial in light of such developments, particularly the attractiveness and speed of new business models, communication channels, and products. Companies and investors must have the capacity to assess options, to seek for advice when needed, and to make the best possible decision considering their specific profiles and goals. I wouldn't like to end the topic of digitalization without focusing on cybersecurity. According to data recently released by the Financial Stability Board, 25% of the cyber attacks that occurred during the pandemic were direct at the financial sector, which was the most targeted sector, with the number of global attacks increasing by a factor of 40 worldwide. These figures reflect the vulnerabilities of new environment, a reality that will be sustained in the future by new forms of work and service provision. Therefore, regulators and market operators face the need for a huge reinforcement of infrastructure and technological capacities, both physical and human. Supervision should shift attention towards operating risk, cyber risk, data privacy issues, rather than maintaining the focus solely on financial resilience. Also because the former may affect the latter as much as macroprudential issues. As a final fundamental trend emerging from an accelerated accelerated by the COVID-19 pandemic, it is inevitable to refer the search for a more sustainable economic and financial model. The climate transition agenda is underway, and its ramifications and impacts on the financial sector cannot be disregarded. Not only do the actions of political actors correctly point in such direction, but also central banks and financial regulators themselves are intensively targeting this subject. Just as an example, A recent ECB analysis clearly states that the climate change represents a major source of systemic risk, particularly for banks with portfolios concentrated in certain economic sectors and specific geographical areas. This is also true for capital markets, namely its asset management industry. But while highlighting the relevance of climate change and the E component of ESG, one should not underestimate the importance of the social and governance dimensions, which have recently gained new equity. On the one hand, the economic impacts of the pandemic generated specific social needs in health, support in old age, and social entrepreneurship, for which the financial system is already being called upon to take the initiative, namely through issuing new products and promoting responsible investment. A strong evidence of the emergence of a new approach to social challenges was given by the European Commission with the SURE programme, conceived as a support mechanism to mitigate unemployment risks in an emergency and made available as of 2020 for member states that need to mobilize significant financial means to fight the negative economic and social consequences of the pandemic on their territory. This initiative is not only already a game changer in respect to a common approach to the ESG challenges, but it may well lead to deep institutional changes in the European Union supported by common debt issuance. On the other hand, the economic and financial impacts on business fabric have emphasized the importance of good governance practices of entities in relation to their different stakeholders, namely its employees and governments. Let me finish by referring to the significant increase in uncertainty as regards the pace of economic recovery and markets behavior, not least due to the heterogeneity of economics agents' financial capacities in different countries, regions, and economic sectors in the aftermath of the pandemic. Given these challenges, a balanced recovery with a strong role for capital markets is fundamental. We face today the opportunity to build a more sustainable future, and the financial system surely has a leading role in it. To succeed, we have to be able to properly identify and assess new risks and be open to and foster new purposes while maintaining financial stability, transparency, accountability, and consumer protection. Again, I wish that our work today proves to be fruitful as always, and I express my gratitude once more to CIRSF and Luís Moraes for the invitation to open for the last time its 2021 conference. Thank you very much.
That we can bear in mind broadly three key or crucial leitmotifs for this panel, including the potential role and contribution of the financial sector for the economic recovery, remaining vulnerabilities and potential systemic tensions in the financial sector, which have already been addressed by the governor and Gabriela Figueiredo Dias, the chair of CMVM, and last but not least, how resuming the banking union and the capital markets union projects can contribute to economic recovery. And I would say that we are very fortunate to have with us, and I thank all the participants heartily because they have busy agendas, but I thank heartily to all the panelists. I would briefly give the floor for an initial statement, for a brief initial statement to each panelist, following the order of the program. So I would start with Anneli Tuominen, who is interim chair of ESMA. Following the order of the program, I would then give the floor to Jan Reinder de Carpentier, who is vice chair of the Single Resolution Board. And we would then proceed to the initial statement of José Manuel Campa, the chair of the European Banking Authority, and concluding with the initial statement of my good colleague and friend, Christos Gortsos, who is president of the academic board of EBI. We are also lucky to have a joint moderation, counting with the invaluable participation of also my good colleague and friend, Pierre-Henri Connac from Luxembourg University and Max Planck Institute. I thank him also for being available for this debate. And now, without further ads and the interest of time, thanking again all the panelists. I do that jointly, but thanking all of them heartily, I would give the floor to Anneli Tuominen. Good morning, the floor is yours.
Good morning, and thank you so much for the invitation. And I also want to thank you, Chair, for your very wise words in your introductory statement. And unfortunately, I noticed that quite a few topics were covered by your presentation or Gabriela's presentation already, but most likely the views are pretty similar, but we hear soon. So I'm really very delighted to be with you on this panel focusing on banking and capital markets union, and the contribution to the development of CMU that protects investors is at the heart of the ESMA mandate, as you can imagine. While the banking union and CMU are mutually complementary projects, both important ingredients of the EU financial system. But as you know, there are major differences between them. The concept is different. The objective of the banking union is to strengthen the Eurozone banking sector stability. It's based on 3 pillars: the single supervisory mechanism, the ECB, and the single resolution board. Still missing link is the EDIS deposit guarantee scheme. I know one of those best, and I must say that ECB, as a banking supervisor, it has been a revolutionary game changer and is really a world-class banking supervisor. It has changed a lot. But on the other hand, speaking of the CMU, it consists of a number of wide-ranging initiatives to support diversification of funding sources for the economy, integration of capital markets, and building trust amongst retail investors. The CMU as such, as you know, it's not a new project. Implementation started 2014. And while a lot has already been achieved, the importance of putting in place the necessary elements and achieve further progress has never been more relevant given the current circumstances. Despite the initial shock to the financial markets, EU capital markets managed to get through the pandemic-induced crisis reasonably well. The existing regulatory and supervisory framework and the market infrastructure were able to withstand the crisis. Furthermore, pandemic accelerated the trend towards digitalization, which can contribute to efficiency and enable wider accessibility to investors. At the same time, we need to remember what Gabriela was saying earlier, that this also means that we are also more prone to cyber risks. However, we need to address risks and shortcomings that the crisis made visible. For example, at the height of the crisis, some parts of the EU investment fund industry faced a significant deterioration in liquidity, large-scale investment outflows, and highlighted valuation concerns. Consequently, it's important that the identified shortcomings in the framework applicable for money market funds or availability of liquidity management tools for investment funds are taken forward. What about then current risks to the markets? While EU financial markets are continuing their recovery, as the global economic outlook has improved amid sustained public policy support, we have also seen increased risk-taking behavior, volatility in crypto assets markets, as well as materialization of event-driven risks last spring, like the Archegos and Greensill. As highlighted in our recent trends, risk and vulnerabilities report, we at ESMA expect to continue to see a prolonged period of risk of further, possibly significant market corrections. The extent to which these risks will materialize will depend on the pace of the recovery, which is linked to further potential development of the pandemic, on market expectations of monetary and fiscal policy support, and on development of the future inflation expectations. The economic impact of the COVID-19 pandemic resulted in an urgent need to support the recovery. At the same time, European Green Deal and the transition to a more sustainable economic model require further mobilization of public and private funding. Therefore, deep capital markets offering diversified sources of financing are essential. Development of more integrated capital markets might stimulate equity financing and contribute positively to growth and financial stability. Now, let me then discuss on specific aspects of the CMU. The 2020 Commission Action Plan on CMU, it includes 16 different initiatives that are progressively being developed. I would like to focus on 3 key aspects facilitating financing of the economic recovery. One of the key prerequisites for a deep CMU is retail participation in the capital market, either direct or indirect through intermediaries. Recent figures have shown an increase in retail participation thanks to factors like innovation and digitalization. Of course, that is a good start. The European Commission has announced its intention to publish a retail investor strategy in the first half of 2022. At ESMA, we will actively contribute to efforts to support retail participation in EU capital markets while ensuring investors benefit from appropriate protection and safeguards. Retail participation cannot be achieved without measures that inspire trust and confidence in the efficiency and integrity of the capital market. Amongst reasons for relatively scarce retail participation in capital markets in the EU can be mentioned things like risk aversion, low level of financial literacy, and lack of trust in the markets, and of course in cross-border context also home buyers. International comparisons show that confidence in financial markets remains low, and many European retail investors are not able to assess risks of even simple financial instruments. That is a real pity. Thinking of direct participation, it requires a more sophisticated investor that also needs to have easy access to high-quality research, including research on SMEs, as well as understanding. So it's a bit more complicated when you want to invest directly. On the other hand, retail investment products in the EU are characterized by high costs that have a significant effect on long-term returns, and ESMA has been doing a lot of analysis in this field. To enable retail investors to make informed investment decisions, MiFID II and PREEP frameworks ensure that all costs and charges are disclosed to the client in a clear and understandable way. In my view, further streamlining of these frameworks is essential to facilitate meaningful disclosure. We should avoid information overload. This is closely linked to improving market access for new and growing companies. European SMEs tend to rely on bank finance, and when accessing capital markets, privilege local markets as the local listing ecosystem plays a decisive role. For example, though venture capital funds can support the path towards IPOs, their presence is extremely uneven across member states. The existing regulatory framework is used to its full potential in some countries. In others, further measures are needed. While we support adjustments to the regulatory regime to facilitate and modernize access to public markets, such as changes in prospectus, funds, or securitization legislation, it's unlikely that changes to regulation alone would be able to achieve a decisive breakthrough. This would require an intervention that is the merit of the national governments, as it oftentimes relates to taxation or insolvency regimes. And of course, it needs also the will of the markets. Finally, I'm a supervisor, so that's the final point I need to say. The completion of harmonized European legislation for capital markets is only a first step to CMU. We should also ensure that supervisory practices and supervisory outcomes are aligned in a manner that is proportionate to the risks. Over the last years, ESMA has done a lot in developing effective supervisory convergence tools. Building trust, however, is a long process. Through these measures, we at ESMA support the overall goal to make EU even a safer place to save and invest and facilitate companies' access to funding. These measures are important pieces in the puzzle called the CMU. Thank you so much.
Thank you, Anneli, for setting the scene, particularly in terms of capital markets. I would now give the floor for his initial take to Jan Reinder, the Carpentier. Thank him heartily for his presence. I know at SLB it's always busy times. Thank you very much for your presence. Your initial take, please.
Thank you very much, Louise, and it's a real pleasure to be on this panel today. You can hear me? No, so it's a real pleasure to be on this panel, and you asked me to be very brief, so I'll do my utmost, and I hope it's sufficiently provocative, I would say, to trigger some questions and discussion. So let me start by saying that the EU made great progress in banking supervision following the financial crisis, and I think there's no doubt that without it, we would be in a much worse situation right now. Let me mention some important developments from our perspective as a resolution authority in Europe. We have resolution plans in place for all the banks under our remit, should they start to fail. Good progress has been made in building up the required levels of MREL. And we are reaching the final stage of contributions to the Single Resolution Fund, meaning that we have now a strong central fund to address the failure of systemic banks in the banking union, with on top the public backstop as from the beginning of next year. So we can say with confidence that the banking union measures certainly contributed to having better capitalized, more resilient banks, which were in a position to play a positive role during the pandemic. Recent economic and earning forecasts, thanks to progress in vaccinations, give rise to cautious optimism, if I can call it this way. But we also know that COVID implications might not yet be fully depicted in banks' balance sheets. Going forward, one of the key challenges for authorities will be to manage the orderly phase-out of temporary support measures. Then my second point, we do not have a perfect framework in place, and it was mentioned before. We urgently need to complete the banking union to face the challenges that may come in the future. A key element of this is the European deposit insurance framework as the missing cornerstone of the banking union. This is a major priority to improve the crisis toolset and overall competitiveness of the EU. And it must be part, in our view, of the Commission's review of the crisis management and deposit insurance framework. Only EDIS would ensure a harmonized and European approach, guaranteeing the same level of protection for all depositors. There exist many ideas about a staggered approach and a so-called hybrid model. My plea today would be to please keep it simple and don't end up with an intermediate step, which becomes the final step. My third and final point would be that we should see European deposit insurance as part of a holistic set of reforms to move forward towards the full integration of the banking sector. In particular, measures to strengthen cross-border financial integration should be considered. Importantly, such integration should also strengthen financial stability by boosting diversification within the banking sector. Liquidity and resolution is still of concern, as we know that in severe crisis circumstances, the SRF, with the backstop, will not provide the final solution. Progress on this topic is also urgently needed. So to sum up, this is not the time to stand still. The pandemic has also shown that European and international decision-making bodies are able to react quickly when needed. So we should not lose momentum and carry out the necessary reforms with a view to have even more efficient European solutions. I think that Europe will only see the full benefits of the banking union when it is completed. Thank you.
Thank you. Thank you, Jan Reinder, for a succinct but very much to the point intervention, touching on key points. I would now move on to Jean-Manuel Campa for his initial take. Thank you.
Thank you, Luis. Can you hear me and see me okay? Very good. Well, good morning to everybody, and thank you for inviting me to be in the panel, and congratulations for organizing it. I will try to be brief and complement the statements that have already been made by the previous speakers, because I share, I think, 99%, if not 100% of what they said. So from my perspective, I would like just to highlight a little bit on the forward-looking challenges that I see coming in, particularly in the banking sector. I think that, as has been said, the last crisis, the last 18 months have shown two things. One is that having a strong banking and financial sector, is a benefit that can help you manage a crisis in a much more resilient way and effective way to minimize the impact on the citizens. And that was one lesson that we learned in the last 18 months. Now, that took place in the banking sector as a result of two things. One, having a good, solid banking sector with good capital and liquidity ratios as a result of the last 10 years, and a good institutional and regulatory framework that has been built over the last 10 years, mainly around the issue of creating a single rule book from the point of view of the EBA, enhancing the banking union, and creating a harmonized supervisory framework within the context of the banking union and the SSF. I think those were great progress that have helped a lot. And the existence of the supervisory authorities, the European supervisory authorities, which Anneli and I represent here, I think has also been helpful in the context of the joint committee. Now, it's also true, and now I'm going to be more precise about the banking sector, that the long-term challenges that were present in the sector did not go away. On the contrary, they probably accelerated or intensified. And I would just mention three. One is a challenge on profitability and orderly restructuring on the industry, where we think that that process is slow and is taking longer than it should and is necessary. And we think that banks need to continue to work in enhancing the sustainability of their business model as they go forward. The second challenge that has been intensified is clearly the need for the technological transformation of the industry and the adjustment to those technological developments. We're holding this virtual conference. I think it's for the second time in a row. You know, it's already been 18 months in which banks and many of us are getting used to operating in a digital world, and that has just accelerated the transformation in the industry that was highly needed, including additional risks. And let me mention two here which are relevant. One that was mentioned by Anual: cybersecurity, cyber risk, cyber threats, operational resilience is ever more important than before, and we need to keep an eye on that as we continue going forward. Second aspect, which I think is important, is that this technology is cross-sectoral in nature. It affects all financial industry, not just banks versus insurance versus other parts of the financial sector. In fact, it affects all of society. So our ability to tackle this in a joint format, you know, with coordination and making sure that there is no cross-border arbitrage, regulatory arbitrage, or anything of that sort, it's an important challenge. Third aspect, it's of course, as we go forward, the transformation of the productive capacity of society towards a more sustainable investment and the ability of the financial sector to channel that. Annalie has already mentioned that. Here I see capital markets union and banking unions strongly complementary. They're always complementary, but in this context, they're even more, because as I think the amount of finance that needs to be channeled to these new sectors, a lot of it has to be done through financial markets, not through the banking sector, you know, because a lot will have to have equity type components, very long-term investments, which are more appropriate for other parts of the financial industry than for debt financing via the banking sector. So I think we need to complement that, and that's a very important aspect in which we need to grow. As we work on that area, and it's already been mentioned by John Ryder, you know, we need to complete the banking union, and this is fundamental. And I think it's important to highlight that we're confronted with a paradox, particularly the banking sector. We made a lot of progress in the institutional setup. We made a lot of progress in the single rule book, in a single supervisory within the EMU. However, we're making much less progress in effective integration of banking services across the union. And that's a paradox that we need to tackle. That's something that we need to be able to make sure that the conditions are there for the cross-border provision of services and the effective provision of services across the union. And I think banking union finalizing with EDIS is a key component, but we need to work in all dimensions to make sure that that happens going forward. So let me stop here and thank you very much for the invitation.
Thank you, Jean-Manuel, for setting the scene also in terms of banking sector. And without further ado, always a pleasure to have Christos Gortsos with us, also in the context of cooperation with EI. Christos, the floor is yours.
Thank you very much, dear Luis, and thank you for having invited me to participate in this very high-level, interesting panel, which makes my position now very tricky, because most of what I would have said has been covered, obviously. And of course, I would fully agree with the statements made that point number one, the banking system was part of the solution of problems during the pandemic and not the cause of the crisis. As we call it, the Basel III effect has been very effective in providing the banking sector with better capital and liquidity ratios, with better quality of capital, yeah, which was very important. And at the same time, I would say that the onset of the pandemic crisis found the European financial system more integrated in terms, at least, as correctly just mentioned, in terms of the institutional infrastructure and the regulatory framework, not only in the field of banking, but also in the field of capital markets, because most of the proposed measures for the completion of the capital markets union are already in place. They were already in place in 1920. Coming now to the challenges, I can see 4 challenges for the banking sector and the financial system, 2 of which I would consider as endogenous and 2 of them as rather exogenous, but again affecting the financial system. Very briefly, my first concern is relating to the profitability issue, and I would link that also to the expected albeit at diverging rates of increased NPLs after the lifting of the moratoria and the public support measures. It has been stressed again and again. We have all read a presentation recently made by the chair of the ECB. We have all read the financial stability report of the ECB. And even though this NPL problem is not as alarming as it was in the previous decade, the fact remains that there will be a reversal from an average of close to 10% and in some years very high percentages of NPLs, including in Italy, in Cyprus, in my country. Yeah, we have seen NPLs. We know the data from the EBA dashboard for the last quarter of 2019 that it was very low, the ratio. Yeah, it is expected to increase again. Again, it will be the case that in some countries the problem will be more severe than in others. And if we link that with other sources of weak profitability for the banking sector, the fact that cross-border integration needs to be accelerated, but you cannot easily dictate that because it involves also market forces, yeah? And market moves which are not easy to be dictated as you have it with a regulatory and the supervisory framework. We have a question mark on that. A second endogenous problem still remains the environment of very low interest rates. Yeah, to the extent that, let me take a very typical example. The negative interest rates on the deposit facility cannot easily be transferred to the clients. So to a certain extent, this has also an impact on the business model of several banks throughout the European Union. A third one concerns within the endogenous elements, concerns the resolvability. There is no doubt, and it was very positive in my view, the fact that the SRB and the national resolution authorities have insisted on keeping a quite wise balance between flexibility on the one hand with regard to some reporting requirements during the first and the second phase in particular of the pandemic, while at the same time insisting on the application of the new rules on the MREL and the TLAC. And it is only with pleasure to hear from the SRB that the MREL built up by several credit institutions, which is necessary in case of failing or likely to fail situation, has been improved. Nevertheless, I'm always concerned whether the other factors relating to resolvability are also able to be met. And this is a quite complicated aspect, and potentially we will have the time to discuss it further on later. Very briefly on the exogenous elements, the one is digitalization. We are living in a totally different environment than we did 5 years ago. On that front, my main concern is the adoption as soon as possible of the new trilogy of the European Commission on the MiCAR and the other two pillars, which would create a level playing field when it comes to the provision of services which are relating to crypto assets. Yeah, we are not speaking here about the cryptocurrency, which is a central banking issue, about the provision of crypto assets. And the other one, I would say we live with that now, is the measures that need to be taken in the financial sector with regard to sustaining the climate conditions in order to mitigate climate-related risks and environmental risks. In that sense, I see a shift in our regulatory framework the first rules on, for example, the taxonomy regulation or the sustainable finance disclosure regulations were mainly addressed to capital market activities. Yeah, they were included. They make part of the capital markets union package. Yeah. On the other hand, recently we have seen that this is shifting also to the banking sector. It is shifting to the lending activities of banks, not only banks providing investment services, but or being listed companies, yeah, but also to the lending activity. In that respect, I'm currently working very much on the most recent work of the EBA on ESG risks and ESG factors, because the appropriate implementation of that will be a milestone for the full integration of all the aspects and all the concerns relating to sustainability to the entire financial system. Because at the end of the day, sustainability affects central banking, it affects capital markets activities, it affects the lending activity of banks, as well as, of course, the operation of insurance companies, yeah, which is, as a matter of fact, derives from the application of the rules on banks and capital markets. I stop it here. Thank you very much again, and I remain available for any questions.
So, thank you very much, my dear Christos, and thank you all for the initial statements. Well, nothing replaces a physical interaction, so we'll do our best to try to organize a digital debate. I would limit myself to flag some ideas which I would address to each of you, and perhaps in a second round I suggest, because it's difficult to organize the micros and the sound, to follow the same order of the program. So starting with Anali and ending with Christos. I would quickly now also give the floor to Pierre-Henri, because I think he could put forward some interesting questions in terms of capital markets. But allow me, as regards banking and resolution, some very quick ideas and comments. Just a brief idea that I would mention here, and results from the various interventions, is the importance of further financial integration and banking integration. And it's curious, and Andrea Andrea has stressed this curiously in a recent intervention, that in the banking sector we had more integration after or in the wake of the second Banking Coordination Directive. Then we had fragmentation due to the great financial crisis, and we have not yet resumed an intense process of integration during the banking union, which is a little bit of a paradox, and there are certainly critical factors on how to stimulate banking integration, while at the same time, I would dare say, preserving some diversity of business models of banks in several member states. But being very quick on Jan Reinder, I would recall here the words of Governor Mário Centeno on the importance of calibrating MREL, and Jan Reinder, if possible, bearing in mind those words of Governor Centeno about the importance of rightly calibrating MREL, I would like your take on this. On José Manuel Campa, I would venture also taking into consideration some comments of Governor Centeno about Basel III. I would like to have your view about the timeframes of the Basel III reform, and about an idea which is very much debated, which is if COVID pandemic should have an impact on timeframes for the implementation of Basel III reforms. And Christos, if possible, I would like your critical take on the prospects that may arise from the current review of the crisis management and deposit insurance framework, which was initiated by the Commission. But first of all, I would give the floor to Pierre Connac for some comments and possibly questions to all the speakers, or possibly also in particular to Anneli Tuominen.
Thank you very much, Luis. Do you hear me? Perfect. So thank you, Luis, for the very nice invitation for this great conference. There are many things, of course, to discuss, but I will focus only on the ESMA part, although I also some ideas on the banking union part. And I wanted to ask some comments to Anneli Tuominen regarding what ESMA did recently in the topic of special purpose acquisition companies, SPACs. So as we all know, there are fashions on Wall Street, you know, like in France, in Paris, or in Milano, and the latest fashion is these SPAC vehicles, which in the US have been a complete disaster. As we know from the works of Michael Klausner, apparently retail investors who got involved into this lost after 2 years. So once the combination is made, they lose 42% on average. Maybe I would say a quick definition of what is SPAC, by the way, sorry, because maybe not everybody is familiar. So SPAC is like a kind of blank check company, which makes an IPO. Promoters get 20% of the company, almost for free. Then they have 2 years to find a target and to merge with the target. And at this point, then they would be able basically to cash in their 20%. And they will also receive warrants at the time where they are going in the market. So it's a way, it's presented as a way to list companies faster than the normal listing process, which in principle will take 6, 8 months, maybe 12, because of course the blank check company, the SPAC, is already listed, and then it's in mergers, and then this takes 3 or 4 months. So this is coming to Europe, and I wanted to commend ESMA for reacting quickly to this, because the experience in the US is simply disastrous. And ESMA issued a public statement 15th of July on SPACs, underlying the applicable legislation, also coming with some recommendations, suggestions. Of course, it's not binding. And I think it was a very nice move from ESMA to get immediately on this and to work on retail investor protection before this kind of bubble becomes too dangerous. By the way, in the US, it has gone down dramatically in the first semester, and then it's a bit up in the second, but it's nothing compared to the first one, 2020, because essentially people have lost so much money now, there's less enthusiasm. But so my point is, if Anneli Tuominen could elaborate on what ESMA has done, and also whether she sees a need for even kind of quick fix legislation on the prospectus regulation, because this is only suggestion at the end of the day. Thank you very much.
We shall follow the same order of the program. Anneli.
Yes, thank you. Thank you for the question. Indeed, this issue was discussed in ESMA earlier in the spring, and then we were discussing, is it now too early to give any kind of statement, issue any kind of statement, because there was not necessarily enough any evidence. Of course, we've seen what had happened in the US, but especially during the first quarter of this year, the volumes were pretty low. Then they started to increase in the second, third quarter. And what was really discussed, that when you see that there is a risk emerging in the market, as a supervisory authority, it's better to react, maybe better too early than too late, because we didn't want to see a situation where the investors already would be suffering because of investing in these instruments. So our statement was really twofold. We also wanted to include this investor protection, this code of conduct side there, saying that the product governance requirements need to be followed, meaning that when supervised entities are marketing these to their clients, they need to really find out whether these products are suitable, because they are risky, and of course the investor needs to understand the riskiness as well. But in addition to that, so there were actually quite a few areas where we asked NCAs also to look into it, that companies in their prospectuses cover different risk areas. As we know, the public statements, the SPACs are generally complex transactions, and differences in company law and market practices in different jurisdictions. They mean that the investors really need to study the structural SPAC transactions carefully, and in order to understand what it is all about. There are complexities regarding safety, like dilution, incentives, sponsors, different way of cost of underwriting fees, and then underwriting fees may be borne by SPAC-leading investors and remaining investors. And there's also the uncertainty as to the identification and the evaluation of target companies. At this stage, we are not considering further action, but of course in the forthcoming prospectus, when we are looking more into the current prospectus regulatory framework, so most likely this could be one of the topics there as well. But found it important that this prospectus contain all relevant information, and also that the intermediaries do their job properly, look after the clients.
Thank you.
Thank you, Pierre-Henri. Thank you, Anneli. I will give the floor now to Jean-Manuel Campa. Needless to add that feel free, each and every one of you, to react also to each other's intervention. But Jean-Manuel, if you could take the point on timeframes for the Basel III reforms implementation, and also if you want to take aboard the rather general point I concede on integration of the banking sector. Jean-Manuel.
Yes, Luis, thank you. Thank you for giving me the floor. Yeah, sure, very quickly. I mean, I think that the Basel III reform that was almost finished, by the way, we're now in the finalization of the implementation of Basel III, but it was almost finished by the time COVID hit, had two implications. The first one is that it showed they have helped us weather the crisis rather than be a burden on the crisis. So it was part of the institutional build-up over the last 10 years that has helped us manage the crisis. And the second aspect is that it also showed that it had flexibility in its interpretation, its application in the way it was needed. And part of that flexibility, of course, was the extension by 1 year of the final implementation of the Basel III, which was decided at the Basel Committee, and that we as the EU institutions supported as well. So by now, you know, as we implement the reform of Basel III, we're talking about the final implementation by 2028, which is 20 years after the crisis. So I think that time is enough. Second, if I may add in that context, you know, and this is obvious, Basel III is a structural reform, right? It's a reform that should help banks throughout the economic cycle, the upward and as well as the downward. So it should not be very contingent on where we are on an economic cycle. And then finally, complementing to some of the comments that Christos said, it's, you know, we just run a stress test of the banking sector, and we published the results of July of this year, the end of July. The banking sector started with a good capital position, better than in any previous stress test that the ABA ran. It was a very harsh stress test with a very severe downward scenario. It led to a depletion of capital of almost 500 basis points, 498 across the sector, but it still remained with a banking sector that ended up with over 10% core equity tier 1 capital, which was the initial position in previous stress tests 10 years ago. So in that sense, that the health of the sector to absorb both shocks as well as the potential requirements of the Basel final Basel implementation is strong. And we also did an update on what would be the capital requirement needed to implement Basel IV, and relative to a previous update, which had been in August 2019, there's been a significant improvement in the situation of banks and a much less needed increase. If I may add one small point on the point that Christos suggested as well, we do expect an increase on NPLs. I think that's an important aspect. We've been warning about this increase in NPLs over the last 18 months. Fortunately, we've been wrong, thanks to the exceptional measures that have been put by fiscal authorities and monetary authorities to provide support to indebted households and corporates. But we do expect that will happen in the coming months more differently, depending on the business model of banks, different depending also on the sectors in which they're exposed. We expect that will happen. One of the good things that we saw over the last 18 months is that the average NPL ratio in the union has actually declined, because some of the measures that have been put in place to facilitate banks getting rid of their stock of NPLs that were prior to COVID-19 actually worked quite well. And we saw, for instance, that in the banking sectors of Italy and Greece, where historical NPLs were high, were able to sell some of those NPL portfolios and decrease the ratios of NPL in a significant manner. So that's actually a good aspect. Now, on the issue that you highlighted, I think that's of fragmentation of the banking sector and how to enhance that going forward. I think for me, that's clearly the challenge that we need to tackle with a bigger urgency. We've been working a lot on creating a single rule book, on creating a single supervision. We don't have a complete banking union. And the outcome at the end, from the point of view of what we see in terms of integration of financial services, the fragmentation continues to prevail. And that's, for me, it's a sign that we're not finished yet and that we need to continue working on that. I think that there are two areas in which we can work. One is finalizing the regulatory framework and improving that. And there, I think EDIS is top of the list of everybody, but I understand that there is real political difficulties to progress on that. The second one is how we can progress within the existing framework that we know is incomplete to try to facilitate. And there, as you say, we put forward some suggestions that could help in terms of better use of waivers, more massive use of the existing regulation, enhanced contracts between parent and subsidiaries in cross-border groups to facilitate confidence of host supervisors there. Andrea, you also mentioned that, put some suggestions earlier this month also how to enhance that. Those are ways to go forward within the existing framework, but both these things need to be worked on. Enhance the framework that we have in terms of regulation and use the existing framework as much as possible. Thank you.
Thank you, Jean-Manuel. I will give the floor to Jan Reinder with the general point, a little bit inspired on Governor Centeno's remarks about the importance of getting it right in the calibration of MREL, but feel free to cover in general operational targets for 2021 and beyond in terms of this critical point, which is MREL. Jan Reinder.
Thanks, Luis. I assume I need to be brief again. But let me first of all say that I fully agree with what José-Manuel just said, and I maybe also take the liberty to shortly react to a comment of Christos. First of all, what I consider kind of positive feedback, if I may, on the way we have been handling the situation when COVID basically started. And there I agree, that indeed we try to keep the focus. So we indeed have provided certain flexibility in terms of reporting, etc., trying to accommodate the situation. At the same time, we also said, okay, you need to continue building your SRF in the right way, continue building MREL, etc. So we did not indeed deviate from our core targets, which would, in my perspective, also be a strange reaction to a potential upcoming difficult situation. That as a supervisor, you would first of all say, well, let's now step back a little bit. So I think there I fully agree. But he also touched upon the other side of resolution planning is progress made, etc. I think there, and you might be familiar with that, we have an important policy statement basically on our website. It's called Expectations for Banks, where we have said step by step, till the end of the transition phase, end of 23, not only the buildup of MREL, but also all those aspects of making banks fully resolvable are there. And we are closely monitoring progress and take this extremely serious, as he is right, that these two legs come together. And that then immediately kind of, is linking to the question of yourself, Luis, and also referring to the statements of Governor Centeno. Correct calibration of MREL is, of course, of the essence, because if you are not able to kind of, to link basically your strategy with the levels of MREL that you put in place, at the end of the day, you run an enormous risk if you get into a crisis situation, because it would mean that you have maybe a fantastic idea about, how you would make resolution work for the specific case at hand. But if there's not sufficient MREL available, your plans will simply not be easily implementable, because, for example, access to the SRF will become extremely difficult if you're not reaching the thresholds. And I think one of our focus areas at the moment is we're working on the transfer strategies to make them fully implementable, and to see, you know, for which banks this could be the preferred resolution strategy or the alternative resolution strategy, and then to also make sure that MREL is adequately calibrated to make this happen. So it really goes hand in hand, I would say, proper resolution planning and sufficient levels of MREL. And now that I have the floor, and then I will stop, is of course, you know, markets are wide open. So we see at the moment that markets are very favorable of building sufficient levels of MREL, and therefore, of course, this is also a great opportunity, I would say, for banks to make progress. We see it happen. We are very happy to see it happen, and we hope that that it will continue like this, and the opportunity is fully taken to make progress, as it is an essential part of, like I said, making banks resolvable. Thank you.
Thank you, Jan Reinder. Christos, the floor is yours.
Christos, I believe you're muted.
I'm terribly sorry. Yeah, thank you. The remark made just now by Jan Reinder means that the expectations for full compliance of banks with the requirements on resolvability will be met. And this is good news. I was recently reading a report by the Court of Auditors on some remaining obstacles. So I understand that this has also been taken into account, because the fact remains that under the system of banking resolution that we have in place, both for credit institutions and for investment firms, yeah, it should be the case that if a bank were to be determined as failing or likely to fail, a prompt decision should be taken within 48 hours. And the concern obviously is not for small banks, but for larger complex banks with branches and subsidiaries abroad, not only in the European Union. Coming now to your question, dear Luis, I have only 3 minutes, so I cannot cover each and every aspect that I would have in mind. Eventually, 3 or 4 points come in mind. Yeah. The first one, it is obvious that in terms at least of design, we need the third pillar of the banking union, the EDIs. In my view, in my personal view, this is a necessary but measure, yeah, to complete the architecture of the banking union. But it is, in my view, again, less important than other aspects, like, for example, the harmonization of insolvency rules throughout the European Union when it comes to credit institutions. Yeah, we have seen that again and again, especially in the case of the Italian banks, that there are some problems there. So in that sense, if I were to prioritize, I would put more emphasis on the second rather than the first, on which I understand there are still some there is still some resistance, which is not nevertheless fully supported by the fact that, if I remember correctly, all the discussions in the various European institutions, one condition for completing the EDIs was the adoption of the risk reduction measures. And the risk reduction measures have been adopted. Yeah, and not only adopted, they are being implemented. Yeah. The CRR2 and the CRD5 and the SRMR2 are in place. So in my view, the time is right. Even though the expectation should not be extremely high, because at the end of the day, it is the banks themselves which will continue to finance the EDIF which will be created. A second aspect which I would like, more technical, but still I need to say that, it's not with the crisis management, but with a crisis prevention framework. There is still, we all know that, an inconsistency when it comes to the application of, on the one hand, the special supervisory powers of the competent authorities, read Article 104 of the CRD4 or Article 16 of the SSMR, and the early intervention measures. There is a lot of overlapping, and it seems not to be clear, which measures would be adopted under what conditions. We have seen again and again that sometimes it's quite unclear, even to the supervisor. If you read letters sent by the previous chair of the SSM to the European Parliament on this, it became clear that even the supervisors have not a clear field. So I would expect that the regulatory framework would be clear. A third point, a major concern for me, is the following. There is no doubt that the bail-in tool is one of the alternative options when resolving banks. But let's briefly consider a situation in our days during the pandemic crisis that the unfortunate condition would be that the bail-in tool should be applied. And my concern is not with regard to subordinated debt or any kind of debt instrument, but it comes to the deposits, and the deposits over 100,000 euros, obviously, because the others are exempted. And I'm mainly concerned about 100,000, over 100,000% deposits of corporates. Can you imagine nowadays having enterprises which are striving for liquidity to get in a situation where their deposits, in a bank which would be resolved, would be bailed in, what the negative repercussions would be on the entire economic system. So in that sense, I would be very skeptical on considering whether the application of the bail-in instrument in deposits should be reconsidered along the lines that I have mentioned. Not to mention that to a certain extent it comes contrary to the SEPA project. The SEPA project leads to the conclusion that if a bank, if a corporate wishes, it can, for example, have a single account, through which to make all its payments. Suppose it makes payments to the employees in all the branches all over Europe, through a single bank account, which potentially could be bailed in. This is a very tricky aspect which one might consider. On the other hand, we are all very much looking forward to see the next move in the implementation of the Commission's proposal for the new framework, on which we could then discuss about the various details. Thank you very much.
Thank you very much, Christos. I think we have roughly 10 minutes for the second round, in which we will have to be quick. I would ask again Pierre-Henri to address some questions, perhaps more focused on ESMA and Anual Tuominen. And in my case, very briefly, and asking you also as much as possible for quick answers, I would ask to Jan Reinder his take on a crucial point, which curiously has also been touched by the Governor Centeno, which is the prospects in terms of assessment of the public interest test, which is vital for the remit of the single resolution board. And to General Camp and both Christos, I would like their critical takes on the other public consultation, which I've referred at the beginning. I think they have briefly touched already some points relevant in terms of the follow-up of that public consultation on supervisory convergence and the powers of ESAs. But Pierre-Henri, your questions possibly on ESMA and capital markets.
Micro.
Micro helps.
Micro.
We need the micro, Pierre-Henri.
I didn't hear your question.
You have to connect the micro.
Yes.
It's connected. Someone disconnected me. It was not me, actually.
Yeah.
Anyway, someone doesn't want to hear my question.
It is the organizers.
Okay, Anneli, but it's also a bit for the other participants, just for you to be aware. Now that's a positive point. I mean, I wanted to just touch base on two issues regarding the sustainable finance, climate change, disclosure, all these elements. There's been a huge drive by the EU, who is really ahead of every other jurisdiction in terms of disclosure, government climate investment tools, taxonomy, green taxonomy. Now we're getting to social taxonomy. So the EU is really ahead of the game in terms of moving toward sustainable finance. But I'm having two concerns here I would like to share with you very frankly. The first one is too much too fast. The amount of regulation which is being poured on institutional investors, listed companies, and so on, is just mind-boggling. I remember in 2017 where people were speaking about regulatory fatigue because of MiFID. Well, this time seems like blessed times where it was not so difficult compared to what is coming. We are facing an issue which I have from different corners, which I want to share with you, is we are facing an immaterial bottleneck, meaning there's not the infrastructure in the companies to deal with all these new requirements. So how can we are moving so fast that we have not, we're not lacking iron or, material stuff, but we're lacking the brain power that is not on the market yet. Audit firms are not ready to deal with all this stuff. And the other point is about whether Europe is not basically creating standards which are so high that there will be a huge difference with the other jurisdictions. So there's an issue of international competition and also of being too strong, because we need one standard worldwide and not 2, 3, 4 standards. And the EU standard seems very strong. And I hear people saying, and I will conclude on this, well, the EU is only representing 8.4% of greenhouse gas emissions. And maybe the EU cannot force its own standards on everybody else. So these are my 2 points. We are going so fast that it's really creating problems on the ground. And second, internationally, also, are we going to have a EU standard which is so high that nobody's going to follow?
Thank you for a very good questions. Unfortunately, many of the answers are not in ESMA's hands, but are in the hands of the political decision makers. But I sense in this project, as well in the MiFID one, that there is very easily the information overload, that too much, and especially when we take into account what the, say, investors, retail investors should understand, so we shouldn't ask too much. On the other hand, the financial service providers, of course, this is very work intensive for them because they need to disclose a lot of information. As you might know, there's a huge increase in the instruments that are called sustainable finance instruments. It's something like 20% growth of environmental, social, and governance fund assets in the first half a year this year, and 40% increase in outstanding sustainable debt instruments outstanding. So of course there needs to be work from our side and from supervisors' side to, for instance, try to avoid greenwashing, because as it happens, it is now trendy also for the intermediaries to be in this business. And when they try to change their product range into green and their tactics, so might be that green necessarily isn't that green when you take a deeper look. But of course, that is, say, when it comes to the investment funds brochures, so they need to be checked that the information is correct there. Whether we go too fast, of course, the things are developing very fast in this field, as you know. I mean, we were talking about this topic 5 years ago, people were not that interested as yet. But now, as we have seen so much evidence, I mean, really what's happening in the climate side, so we understand the urgency, and of course the urgency is also then reflected in the regulatory field. And then it's our task as supervisory authority to do all the regulatory work, and then also ensure that it is well respected by national authorities and companies.
So, thank you very much, Anneli. I will mute myself now, as from now, and very quickly, Jan Reinder, Jean-Manuel, and Christos for your final remarks.
Thank you, Luis, for giving me the floor again. And let me just shortly react to Christos, and thanks again, Christos, for your very, very valuable comments. Indeed, we are very committed to these expectations for banks, and this is our roadmap, and we take it extremely serious, step by step, to fully use the transitional phase to get where we are expecting to get. So that is indeed how I see things, or we see things at the SRB. You were trying to kind of change a bit the order of priorities in terms of EDIS versus harmonization of insolvency laws. I agree with you. The importance of the harmonization is clear. We have said it many times. It's also not an easy thing to achieve, but progress there is definitely needed. Putting it in a certain order I always find difficult. Both things are extremely important, EDIS and harmonization of insolvency laws, and let's see where we are heading for. Then on the PIA, so the public interest assessment, also a very important element of our basically of the framework, that basically is making that distinction between national insolvency proceedings as the default option or the application of resolution tools when there is this public interest. What we have been doing in our policies is to basically enrich the policy further with systemic events, systemic-wide events aspects, which basically leads to a broadening of the way we look at PIA. But what I also consider important is that the authority, the SRB, the authorities involved, keep a certain flexibility there in terms of the application, because, like I said, the national insolvency is the default option, and the public interest is needed to basically justify the application of resolution tools. So we're working on it from our perspective in our new policies and fully implementing those policies. And then we'll see where we end. Thank you.
Jean-Manuel.
Yeah, Luis, thank you. I'm conscious of time, so I'll be very brief. On your issue of supervisory convergence, of course, it's been one of our key topics since the creation of the EBA. I think that in the area of the prudential supervision and also on recovery and resolution, since the creation of the banking union with the establishment of the SSM and the SRB, I think there's been a huge amount of progress there, and that has helped a lot. As we look forward, we've been putting a lot of emphasis on other areas now of supervision. We are very prevalent and become more prevalent. As you know, we have a mandate on AML since January last year, and we have a committee, and we're putting a lot of effort there to try to enhance the supervisory convergence in that area, which we're very keen of the proposals that will be put forward by the Commission to enhance regulation supervision at the European level in that area. That's a good progress. And I also say in the area of the new technologies, as we think about operational resilience, new technologies in that area, we need to make sure that we have adequate supervision of the new risks that are arising. I mentioned before cyber risk. So let me stop there. Thank you very much.
Thank you very much. Christos.
Yeah, on the issue, thank you, Luis, on the issue of the Europeanization, if I may so, of supervision in the three sectors, there is no doubt that if there are any elements of a home bias, element in banking supervision or capital market supervision or insurance supervision, this progress towards creating pan-European supervisors is only welcome. And we have seen that, obviously, in the case of the ECB. Now, when it comes to the structure, the current structure, we see a total asymmetry in the sense that, according to the treaty, the ECB could take over the banking supervision. In the field of insurance, there is no centralization at all. And in the case of the ESMA, we have already some powers of this agency, which will be enhanced by next year when it comes to the administrators of the key benchmarks, or even with regard to the data reporting service providers. So this is a very welcome development. It's a pity that it was not the case with the crowdfunding supervision. Nevertheless, we all know that there is still an institutional obstacle to this, in all cases. And by the way, the EBA is expected also to take some direct supervision over the asset, the significant asset token and e-money institutions once the MiCAR will have been adopted and this will come in place. So this is another move forward towards Europeanization. We all know, nevertheless, that there is a missing element, which is the powers given by the treaty. At the end of the day, even in the case of the ECB, the final decisions cannot be taken by the supervisory board, but they must be taken in a way by the governing council. So in that sense, any further move towards Europeanization of supervision should be dealt with even at primary law level. But this is a very, very long discussion. Thank you very much.
Thank you very much, Christos. This would invite a new debate to which you are all invited physically, if possible, in Lisbon next year. And on this note, I thank you heartily, the five of you, very much for, I think, a stimulating debate, regardless of technological hurdles. And I thank you all. And without further ado, I would hand over the conduction of the proceedings to Pedro Gustavo Teixeira, to my good friend Pedro Gustavo Teixeira, to start the second panel of the conference, and would ask the panelists of the second panel to turn on their cameras. Pedro, good morning. I'll mute myself.
Hello, good morning. So it's a tough act to follow such a nice panel, but we will try. So I see, I don't know if Vito Constancio is already connected. I see Torsten, Luis. Yes, I see.
Yes, I'm here.
Yes, hi. So good morning to all. And so now the second panel is, as you know, on the financial sector, the economic recovery and reform of economic governance. And with us, we have then Professor Forsten Beck, Director of the Florence School of Banking and Finance, and also Financial Stability at European University Institute. Vito Constancio, that was, as you know, Vice President of the European Central Bank and Governor of Bank of Portugal, and now is the chair of the School of Board of Lisbon School of Economics, and Luis Garicano, a member of the European Parliament and member as well of the Econ Committee, head of the Ciudadanos delegation and vice president, economics coordinator of the Renew Group, but of course also professor in Chicago and LSE. So maybe then, since we have, I believe, around 40 minutes, my idea will be to have 2 rounds of questions. And so if you could be relatively brief in your answers. But the first one regards, of course, now the moment we are going through of a lot of uncertainty. And as the pandemic hopefully subsides, what is your top concern regarding the ongoing recovery? I mean, and you can focus either on the financial sector or the broader economy. And so what are for you the main risks going forward? And maybe starting alphabetical order, Forsten, if you don't mind starting.
Yes, well, thank you very much, first of all, for inviting me in, for participating in this panel. So my main concern is that we won't get the balance right between Keynes and Schumpeter or Keynes and Hayek. What do I mean? So on the one hand, governments across the world have come in very powerfully since last spring in terms of supporting the economy, supporting society. Now, of course, there's also an economic purpose behind this in terms of avoiding hysteresis, right? Avoiding that people lose their work and stay out of work and don't come back in. And I think this support is certainly necessary. The question, of course, is, and that's the other side, is that eventually, when the markets work again, we have to get back to the kind of the market, the role of the market in terms of allocating capital, allocating labor, and so on. And that's going to be the question. The tension is when do we move from one regime to the other? when do we go away from the furlough schemes, the Kurzarbeit, the support payments, to again a reasonably well-working market? Maybe not quite yet. I mean, supply chain problems are still there, but where is the stage? Too early? That would again result in hysteresis. Too late? That might lead into kind of zombie firms, zombie lending, and actually hold growth back for longer than we want to. Now, based on this main concern, let me go into two kind of sub-concerns, so to say. One macroeconomic and one on the financial sector. In macroeconomics, I think what I'm really concerned about is fiscal austerity, to put it bluntly. Going back to where we went wrong after a few years after the global financial crisis. I mean, I think the worst case scenario would be a second euro debt crisis, to put it very bluntly. And of course, everybody's looking right now. One of the reasons everybody is looking right now to Berlin is because I think the new German government will set the tone, not the rules, but the tone in terms of how we continue with fiscal policy. And I think, I mean, there are lots of reasons why we should not shift the stance to a restrictive, constraining fiscal policy stance. I mean, the climate change, the transition to net zero comes to mind, but I think also in terms of the cycle, that's a very important thing to keep in mind. Now, my second kind of sub-concern, so to say, is concerning the financial sector. And again, coming back to this exit strategy from the support programs. So as we also heard in the last panel, the situation doesn't seem as worrisome as it looked like last year in terms of corporate fragility, corporate insolvency, and therefore also in turn on what is on banks' balance sheet. But I kind of doubt that we really have the full picture yet. Only, as the saying goes, when the support is gone and the water kind of the tide is going out, then we see who has been swimming naked. And then we're going to really see the true picture in terms of corporate fragility, and of course also the need, like which corporates will be still viable, which one will not be viable anymore, and among the viables, which one have to be restructured in terms of over-indebtedness. Now, this is of course the one side. The other side is, of course, I mean, these corporates, many of these corporates depend on bank lending. At the same time, we want to also have a very transparent bank balance sheet to avoid a situation where we go into zombie lending, which ultimately will not just hurt banks, will also hurt the real economy, will hurt, of course, in the long run, growth and unemployment. So kind of, again, balancing this transparency on banks' balance sheet, avoiding zombie lending, at the same time pushing the necessary restructuring in the corporate sector. I think that will be another important element. And of course, this again, I think you're going to come back to this maybe in the second round, will have implications, of course, how we go about the whole kind of financial safety net in Europe in terms of bank resolution and so on. But maybe let me stop here. Thanks.
Thanks a lot, Forsten. Vitor Constâncio.
Yes, thank you, Pedro, and thank you also to Professor Luís Moraes for inviting me to participate in this great conference. So answering your question, Pedro, regarding the financial sector, I have three main concerns: increasing non-performing loans in banks, a continuation of credit supply restrictions by the banks and possible down the road deleveraging, and regarding the rest of the financial system, the situation of money market funds and investment funds in what concerns liquidity mismatches in their balance sheets. The European banks have apparently, of course, resisted very well to the COVID crisis, keeping very high capital and leverage ratios, and enjoying even a stock price rally since October, although the level of stock prices are still below what they were in February of last year, which indeed means that the European banking sector is still under a cloud of uncertainty. The profitability declined last year, of course, to a ROE of 1.3%. And the ECB has forecasted that it would be going up to 3% next year and 6% in 2023, which is of course well below the cost of equity of banks. So profitability, which is indeed perhaps the main problem of the European banks, its progress confronts increasing NPLs, higher loan loss provisions this year and next, and low interest rate margins and decelerating credit volumes. For instance, the credit to non-financial corporations increased at last year at a certain point in time by more than 7%, and it's now increasing just by 1.7%. So some banks may suffer more than others because the situation is very heterogeneous, and they will confront after the end of public support schemes like moratoria, forbearance, public loan guarantees, and so on. They may face situations of more difficulty. So there is a tail risk of a situation of credit supply restrictions going forward, with banks continuing to tighten lending conditions and deleverage and not using the capital buffers that are there to be used according to the SSM, and letting capital ratios then adjust. So the supervisors have to address this risk, this tail risk, which would be very detrimental to the recovery down the road. Turning to the economy, well, this year and next will be good years of growth because it's mostly about catching up after a big recession. So potential problems come later, as growth will decelerate to the growth potential of our economies, which in the euro area is little more than 1% just, and 2% in the US. And by the way, the latest Fed projections for 23 and 24 growth in the US already show this level of just 2% for those years. So that's when the problems may emerge. There is still in the euro area a significant negative slack. Unemployment rate is predicted to increase in this year and next to levels slightly above what it was last year. The broader concept of unemployment, U6, is still at 15% level, and about 3 million workers are still without employment in comparison with the level of employed persons in February of last year. So we need macro policies to aim to high-pressure economies. And the concerns come, of course, from the fact that both fiscal and monetary policy are about to become less expansionary or more restrictive, if you wish. Monetary policy through reducing bond purchases, and fiscal policy because, of course, after the big deficits of 2021, there would always be a reduction of the expansionary stance, and all forecasts indeed point to lower total fiscal impulse and even to a reduction of the fiscal stance, as it is shown by the annual change in the structural primary balance. So, but the crucial concern, of course, and I agree with Thorsten on this, is, however, about what will happen to the fiscal rules that have been suspended, as you know. If they go back in 23 to fundamentally what they were before, then I think there will be a big deceleration of growth further down the road, with no elimination of that economic slack, with all the scarring induced by the COVID crisis.
Thank you very much. And then we'll come back to this on the reform of fiscal rules in the second round.
Yeah.
Luis Garicano, if you could now intervene.
Thanks very much. This was both Victor and Torsten were really interesting and insightful. So it's a pleasure to be here, and it's a pleasure to be able to participate. I wanted to start with a reference, a short reference to what Torsten Beck said about Keynes and Hayek. And I think he's very right. We went for many years until the 70s through a Keynes only phase. Incentives don't matter. Then we've gone to micro phase. It's all about incentives, and we don't worry about aggregate demand and aggregate supply. And it seems like in this crisis, we've gone to pure Keynes. We're not going back to the center, but we are just worrying about aggregate demand and issuing debt and maintaining the aggregates, and we're forgetting that there is time inconsistency problems, that politicians like to spend money. It's just logical. I'm one, and I can tell you, it's a secret, but here I tell you, they like to spend money that promises that moral hazard does exist, that you insure people and they take more risk, and that we need to worry about that. And I think that the pendulum swing is too fast, and I agree with Torsten Beck as to this being a risk. Now, one thing that I will add is about financial dominance and moral hazard, if you want, in the financial sector. So I don't know if inflation will go up, and I don't think anybody knows in a persistent way. I think there's a risk of a wage price spiral, but we don't know it. I can tell you that Spain had yesterday industrial prices going up by 18.8%. This is a lot. I mean, of course, you will tell me the baseline is low, there was a drop last year, sure, but it's a lot. If inflation were to return, which I don't know and nobody else does, would the central banks be able to act? That's the question that I pose. And the European Central Bank, and I would love to hear Mr. Constancio about this. The European Central Bank put in its strategy review in section 9 on financial stability, which says financial stability is a precondition for price stability. The truth is that there is a conflict between the two. The truth is that sometimes, asset prices, move in opposite directions from rates. That's just the basic fact. And also there is moral hazard issues when you told people that you're going to insure them, that they don't have to worry, financial stability, asset prices are targeted, they take risks. I mean, this is the famous Greenspan put. I hope there is not an ECB put in the future. Which means that if the central bank starts to be worried about inflation, starts to stopping QE, people will make the reasoning that Victor Constancio make and say, well, there's a risk, blah, blah. So I think the central bank eventually will be scared and go back. And my concern is about the consequences of that, which is if everybody thinks that the central bank is insuring them, they're going to take too much risk, and we're going to be in trouble. And we've seen that happen before. So I am afraid of financial dominance, both because of the risk we will take and because of our inability to fight inflation if it returns. Third point and last point, the financial sector reforms. Huge problem and huge concern for me, and I know that's going to be the second round of discussion. But let me just say that the legislative agenda in Brussels is stuck completely. That, in my opinion, the banking union is not advancing, and it has a risk of going back. As you know, the doom loop is not been eliminated. If you think just of Spanish data that I know best, the Spanish Treasury as a percent of Spanish government debt in the Bank of Spain went up from 5% in 2012 to 31% now. So all the Spanish debt, the increase in Spanish debt is really funded by the Bank of Spain. Domestic banks have also kind of hold quite a bit of debt, but it's mainly the Bank of Spain. And fragmentation has barely improved. So cross-border lending remains very low. It went down after the financial crisis. So financial sector doom loop type of considerations, fragmentation type of considerations, the banking union is not there. And as you know, there was a big roadmap that the government had to do and to put in place that basically didn't conclude in June. That was supposed to get things going. And essentially what it means is that both because of the German-Italian conflict on sovereign exposures and deposit insurance, and because of the home host issue that basically France versus the little countries face, we are basically stuck. We're going to have two files, Basel III with the CRR and the CRD regulations, and we have a crisis management package that supposedly is going to come, but everything right now looks stuck. Maybe Germany gets reform-minded chancellor, reform-minded finance minister, and everything gets unblocked, but at the moment, that's a big concern for me. Banking union is the Rolls Royce in the garage. We have a beautiful resolution system, doesn't do anything. We don't have a deposit insurance. That's a trouble.
Thank you. Maybe I cannot resist to ask Vito Constanzi if you would like to react on the discussion regarding inflation, since it has been the topic here at ECB as well.
Well, I am on the side of all major central banks in their forecasts and the forecasts of all international organizations from the IMF to the OECD that show that there will be a sudden deceleration of inflation next year. And all the elements that we have now come from supply side shocks on several elements of shortages that, of course, our developed economies are capable of overcoming in a reasonable period of time. So these will go away. And as you know, also, when inflation is induced by supply side shocks, monetary policy should not respond because it would be counterproductive. So, and that's what is happening. So I am on the camp. Also, I don't see any chance of a wage price spiral because indeed, particularly in the US, of course, but also in Europe, you know, workers and trade unions have not the power they had in the 70s or the 60s when we had examples of wage price spirals. That is not possible right now in terms of the social situation that we have. So inflation will go down, Now we are in a spike because of these temporary factors, but will go down, and that's my view. I am concerned, though, with the problem of financial dominance, which is already very clear 100% with the Fed. It's a total capture in terms of financial dominance. I hope that the ECB will not go there. And I point to apparently a detail, which is that whereas the Fed talks about financial conditions, the ECB talks only about financing conditions. And what is missing there in the financing conditions is stock prices. That's not included in the financing conditions. There is a difference, and I think that indeed the ECB will behave differently from the Fed in what regards the risk of financial dominance.
Thank you. I think Forsten, you also wanted to react.
Very quickly, maybe. I think actually Victor already said it. So I also don't see this kind of wage price inflation spiral. I mean, there is just as an additional argument. It's supply side driven. It's from a lower point, but we also know from previous experience. I mean, the transition economies, for example, early 90s, that if you have reallocation in the economy, there needs to be space for more inflation. Of course, we cannot compare our situation to those of the transition economies in the early 90s, but still, I think that's another argument of why there will be both temporarily higher, but then also more volatile inflation. Now, of course, there is an issue, just to bring this in here, there is a political narrative issue, right? I mean, we know there are two definitions of hyperinflations. The standard definition is above 50% per month. The German definition of hyperinflation is over 2% per year. So there might be political pressure coming on the ECB to maybe too trigger happy. So this is kind of the opposite side, I guess, from the fiscal dominant. But of course, there's the other issue is, I mean, I think what we saw over the last decade is that there was too much burden on the ECB in terms of crisis fighting. And I think we're now slowly seeing a way towards fiscal policy taking a stronger position. We don't want to move away from this again, right? So I think that's I would say an important thing to keep in mind. And then finally on that, I mean, yes, I take also the point, of course, of what Luis said in terms of the asset prices, but we do have an additional tool by now, which is macroprudential, and which I think has not been used sufficiently in Europe, maybe partly because it's still on a national level. So I think that's maybe coming to the next point, actually, to the reform agenda. I mean, I think that's maybe something to consider to kind of try to bring this up a little bit more to the European level. Thanks.
Yeah.
So thank you. So maybe I'll return to Louise also then about the reform agenda, because indeed, I mean, the discussion on inflation here at ECB at the forum yesterday or before yesterday, I mean, one of the preconditions was also the policy framework. That, I mean, we have to have a credible policy framework, not only on the central banking side, but also on the economic governance side. So maybe Luis Garicano, if you would like to now talk a little bit. I mean, you already mentioned some, but what will be your priorities then, take into account the concerns? What shall we do in terms of economic reform and the governance of the monetary union?
Let me just address make one comment about inflation. I am no expert. I have friends whose job is to forecast inflation for a living, and they tell me it's impossible. But of course, Vitor knows much more. One thing that I would just point out is what Larry Summers has pointed out about past inflations, which is they look like supply. I mean, when you have a supply shock in like 9 sectors, when does it stop being a, oh, well, there's a scarcity here and there? And Summers' point was that it usually shows up in scarcities in electricity, in gas, in oil, in drivers, in as many things separate. We had a price wage spiral, both your country, Portugal, and my country, Spain, under the dictatorship. I don't think the unions were very strong. So I've never been very big fan of the unions as being the ones that caused this spiral. I think it's more like, I mean, it's a much more broad pressure, I think, to keep up. I mean, obviously in democracy, I made maybe too strong a statement, because it definitely, it's definitely been also the case. But what I'm trying to say is, I think there's a big band under the confidence intervals that any of us can have on inflation expectations, and that means on our expectations, not public's expectations, and that means that the risk is there. And I'm not saying there is inflation going to come. What I was saying is, if it comes, I'm not sure the banks have the independence and the tools to do it, given the huge leverage buildup that we have seen. On reforms, yes, I'd love to talk about reforms. The basic issues on which this legislative agenda seems stuck in Europe are two. One is the home host issue. There's a big conflict between the little states, which are hosts to banks from big states, which want, I mean, this is unclear, right? When you hear the little states, I've talked to several countries on this, and they say, well, we want to be sure that the money is going to be there when there's a crisis and that the bank doesn't take it home. We can deal with that with deposit insurance. But sometimes you hear other things which are more worrying. Oh, we want to make sure we can direct credit to our domestic sectors, and with a foreign bank we cannot do it. Well, if that's your concern, then you don't want banking union, okay? Then we are in trouble. So the home host issue is really huge for many banks, for many states. Banks in the states that are funding this resolution fund are complaining and saying, well, we're paying up to 70 billion in total for this Rolls Royce that stays in the garage, for a fund that never gets used, because we cannot do resolution without deposit insurance, we cannot get deposit insurance, and we cannot solve the home host issue. So basically people start to think this whole thing is useless. Second issue which things are stuck is deposit insurance. Okay, so as long there's interrelated, right? As long as there's no ADs, the host countries have a good excuse to ask for money to be held in the subsidiaries, because, like, look, I'm going to be responsible for saving these banks. I need to be sure that there is money there. At least they have a case. I'm not saying, and I would love to hear my other two colleagues, esteemed colleagues, points on this. At the 26th of June summit, the leaders reaffirmed their commitment, but honestly, this is just not happening. So the EDIS file arrived to the European Parliament in 2015. It's been basically stuck in Parliament and stuck in Council. And as far as I can see, these two issues at the day of today are crucial. If we don't advance, I remind you, Campa is not here any longer, but he will know very well what happened. I think Vitor was probably in the job still when this happened. The Popular, Vitor, were you there when the Popular
yes
failed? So you remember this. I mean, Popular was basically half an hour away when Santander rescued it on a Wednesday morning at 7:30 in the morning. It was half an hour away from having the police guarding the branches, because literally there was no money in the ATMs. People would have been going there trying to pull out their money. This cannot happen. I mean, we all think this is a success story, but it was very close from being a tragedy. So I think we need to solve the deposit insurance if we're going to get resolution to work. We need to solve the home host issue. And on both of them, politically, I'm very worried.
Thank you. Maybe I would now to do the circle, go first to Forsten back and then Vitor Constancio. Forsten, please.
Yes, thank you. So to kind of actually follow up on what Luis just said, when talking about the reform. So yes, maybe as a background, I mean, I think for the recovery, we need not just supportive fiscal policy, we need a strong banking sector. I mean, it's kind of, maybe it's too obvious to actually state that, but I think that's, we should just state it again. And I think what we've seen is, I mean, I always like to talk about this kind of the three legs of the banking union, and we had actually effectively only 1.5 so far. We have a strong one, the supervision. Then there is this half one, single resolution mechanism, but I'm not even sure whether it's half anymore. I mean, resolution has been really nationalized again, and I think that is a very big issue. And I think actually it ultimately goes back to what I would like to call the original sin of the banking union. There was this new financial safety net, this new regulatory structure imposed on a banking system that was in several countries still working through the fallout from the global financial crisis and the euro debt crisis. In the country where I'm currently located, Italy is a best example of that. I mean, the can was kicked down the road again and again and again. And I was just actually looking again into the case of Monte dei Paschi di Siena, which for obvious reasons, but it's again in the headlines now. But actually, if you look at FT, if you search for Monte dei Paschi di Siena, you get 22 pages of articles on that. So it has been a long saga, I have to say. So, but I think this really shows that this has not really worked very well beyond supervision. So really have to complete the banking union. On the home host issue, let me give you an additional perspective, which shows again this whole fiscal and this banking all hangs together. So we had in spring last year, ECB, ESRB, EBA all kind of recommended, there was no official step, but recommended that banks do not pay out dividends, the payout restrictions. And that was typically, I mean, I was involved in the ESRB, it was on the group level. However, several countries, what Luis referred to, kind of the small host country, actually imposes also on the subsidiary level. Basically saying that subsidiaries of the big banks should not send money back home, the profits to their parents, and the argument being basically, well, look, I mean, these subsidiaries benefiting from fiscal support measures, number one, and number two, we don't have a complete banking union. So you see that in the crisis then again, you have this kind of disconnect. You have again conflicts between home and host country. Now, this didn't really blow up because it wasn't really a big issue ultimately, but again, it shows that when it comes to shove, there is not enough. The banking union is not complete. And again, what Luis pointed to, of course, the EDIS is one important element, but also having resolution truly on the European level, and not just resolution where there's a public interest assessment, a positive public interest assessment, but also resolution tools also for smaller mid-sized bank is really important if you want to move away from the default option of national resolution with ultimately again bailouts. I mean, that's what we've been seeing again over the last couple of years. But I think, I mean, just to kind of put a kind of a cherry on top of that, and I appreciate, of course, all of Luis' enormous efforts in Brussels to kind of push this agenda forward. Ultimately, it's all about politics. I mean, again, we see it here with Monte Paschi and the Siena and the local politicians. We've seen it in your country, in Spain, Luis, with the Cajas. We've seen it in my own country, in Germany, with the Landesbank. I mean, as long as politics doesn't get out of the way, we're really not going to get to the truly European banking sector. Getting to a truly European banking sector would resolve many of these issues. And I think all of these regulatory reforms are the necessary but are not a sufficient condition to get to a truly European banking system. I think that's ultimately what we need. Now, I haven't talked about fiscal rules, so maybe I leave this to Victor, but I think, of course, that's another discussion which we probably won't have the time for. Thanks.
Thanks, first, maybe Vito Constanzi can also deal with the fiscal rules. I mean, you started.
Yes, I will, because it's my main concern right now, and I think it's the more important thing for Europe going forward in the next, visible horizon. I agree with Luis and Thorsten that banking union and capital markets union and the European safe asset are stuck indeed. And I don't see really how this can be unblocked. I hope that next year, with the review of CRR and CRD, the macroprudential role of the ECB/SSM will be enhanced. Finally, that they will be recognized as a macroprudential authority in the law, which they are not, and will be given a little more powers to really intervene. But I will concentrate on fiscal rules. Now, the problem is, of course, that we have reached a very low level of interest rates, and so monetary policy has diminishing returns and has lost effectiveness. And it is important to keep in mind that interest rates have been going down for 35 years, long before the financial crisis or monetary policy, QE and quantitative easing and all of that, long before. For many structural drivers, we have no time to go into. Now, this happens, in my view, and many other macroeconomists, happens the assigned roles to fiscal and monetary policy in the old consensus. In the old consensus, fiscal policy macroeconomic role was to take care of the debt level, and monetary policy would be in charge of full stabilization in the US with the dual mandate, or just inflation in Europe for the ECB. Now, the new consensus, or the new situation which speaks very loudly in this period of secular stagnation, is that fiscal policy must assume a more active role in stabilization function of our economies. If anything would be missing, we have still the lesson of our double deep recession in 11-13, which was totally determined by the simultaneous fiscal consolidation of all countries, not just the periphery, all countries then. So if we go back to the previous fiscal rules, more or less, in 23 onwards, then, as I said, we will have a much higher restrictive, more restrictive fiscal policy and a significant growth downward path. And the problem is mostly with the debt criteria in the fiscal rules. We have this, in my view, absurd level of debt as a target, 60%, and a mechanical formula for convergence to this 60%, which imposes that any excess over 60 must be reduced by 5% every year, which after COVID, an increase in debt is a killer, of course. Well, the 60% are not even 60%, because 60% are in the treaty. But if you take the Stability and Growth Pact, it changed the treaty, because it imposed that the budget should be in balance over the economic cycle. Remember the Stability and Growth Pact, which means that if indeed over every economic cycle, the budget should be in deficit, in the very long term, debt will converge to zero over GDP. And that's even, of course, more absurd. Now, the 60% rationale at the time was twofold. First, it was more or less the average of the founders of the monetary union, and more economically, assuming that countries would be, and that was the worst possible scenario, would be with 3% deficit every year, which was the limit, as you know, and they will be misbehaving and having 3% every year. Then the rationale was that nominal GDP growth would be 3% real, 2% inflation, and 3 over 5 over time gives the 60%. Well, we are not there anymore. Our potential growth is hardly now a little more than 1%. So if you do the same exercise now, 3% over 3.25, taking 1.25 for real growth and 2% inflation, gives a path, a limit to the debt ratio of 92%, not 60. And if you are more optimistic and consider 1.5 potential growth, then it's 85. And the average in 2019 of all members of the monetary union is 86, precisely very close to the 85. So desirable, there should be a new target or a substitution of a target by regular debt sustainability analysis for every country, and thinking also that we should move, as many economists and institutions have proposed, moving to an expenditure rule, where the expenditure is controlled, taking into consideration the long-term debt sustainability and the growth of the potential growth of the economy. And that would take care because, of course, in an expenditure rule, the deficit is endogenous. It's cannot be subject to a target of 3%. It's endogenous because it depends on the revenue side. Only the expenditure is controlled. And we know also that perhaps now there would be justification for a certain exclusion of some public investments for the greening of our economies that are needed to crowd in the huge amount of private investment that will be necessary. So it is essential to change this. And if this is not changed and we go back, perhaps my prediction is that the maximum that Germany in the end can accept, and it will be Germany deciding, by the way, take my word, because I have gone through from the inside with every detail of the evolution of the fiscal rules since the inception of the Stability and Growth Pact. Germany,
you are who understands them.
Yes,
the one person.
And of course, perhaps the maximum that I expect that the new coalition in Germany can accept is to get rid of the mechanical formula of convergence to the 60%, which is not enough in my view, and puts, that's my last point, huge pressure on the ECB again to decide perhaps not a drastic reduction of bond purchases, because then if fiscal policy becomes really biting and more restrictive down the road, it's not for next year, then the ECB will be under huge pressure, and then we have problems potentially with the normalization of our macroeconomic policies.
Thank you. I think we, if Luís Moraes doesn't mind, maybe to stretch a little bit more the time just for a final round of comments. I think picking up on what you were saying, but I think, all the citizens are expecting that the recovery and resilience programs will bring something very positive and change. Maybe if you could conclude the debate with your feelings about the content of these programs and what you think will be their impact, whether indeed it will help going through the recovery and reaching a new level, also in terms of climate change. Maybe Luís Garicano.
Thank you. Let's see. So on the fiscal rules, I'm not very optimistic. I think, but what is probably on the horizon is getting the green investments out of the debt breaks in Germany, and I don't know if that's going to be I don't know if that's going to be the solution that Victor would like to see. On the recovery and reconstruction plans, I mean, basically, here we have the typical compromise that doesn't satisfy the two sides. We wanted to fill up the investment gap, to have a kind of Keynesian recovery plan that would kind of provide with, you know, employment growth, wage growth, and investment-driven growth through climate and digitalization over the next few years. But at the same time, we wanted a structural reform plan where countries really made the reforms and the adaptations to the green economy and to a more productive and more humane, more sustainable economy. Those two objectives, as Blanchard very, very early on said, were in contradiction. I mean, if you want Keynesian stimulus, you need to take the rules out and spend. And if you want reforms, then you have to do things well. And the risk is that they don't do either, that the money gets bogged down internally, but at the same time, it doesn't really do the reforms. How optimistic am I? I mean, I'm more on the second camp, I have to acknowledge. I'm more of a person who wants this money to stimulate real reforms in the countries in terms of labor markets, education, etc. All the constraints, particularly on some countries like the Southern European countries. And I've seen some progress. I think France has done some good things. Italy has a plan with a strong political support, with a big effort to change the justice system, which I think would be amazing. Greece has some good ideas, but I'm not sure if the reforms are going to be enough and sustainable and sufficient. And on the other hand, is the plan going to provide the needed stimulus? Yeah, I mean, to some extent, right? There is an important amount of fiscal expenditure that will be available to all these countries. It's an enormous amount of money. I mean, for Spain is 7% of GDP. For Hungary is 5% of GDP. I mean, we're talking about big numbers. But I am kind of worried. I've been very much driving the push from the Parliament to do it. I've been very enthusiastic about having this money available, but I have been a bit disappointed on the reform side that the Commission has been maybe a little bit soft on. Today we were fighting with the Commission over the Hungary and Poland plan. Are they really demanding Hungary and Poland put in place the controls, anti-corruption, and the reforms that they need to do? And I'm not convinced that the Commission is really, they want to be loved, they want to do the recovery, and I'm not sure they wanted to do the reforms.
Thank you. Forsten?
Yes, thank you. Very quickly, so I'm not quite sure I agree with, maybe I misunderstood the Blanchard argument that the two things are kind of exclusive. I mean, you can smooth the reform plan with money, I would say, reforms with money. I mean, we've seen it with the Schröder reforms in Germany in the early 2000s. So now, I agree that it's very hard to implement reforms from Brussels. I mean, we've seen this before. I mean, Greece was the best example that didn't really work, although there wasn't actually money for that to smooth, right? But so I think there's a lot of national responsibility that has, and that, of course, I agree with Luis. There's more has it involved. So I think there's no perfect solution to that, to this problem. But I think, I mean, again, we haven't mentioned that word yet, but the Hamiltonian moment, or I call it more the Hamiltonian glimpse at the possibilities of moving towards fiscal union in Europe. And I think there was an important glimpse, the important first step. So I think that has to be strengthened further, while at the same time also kind of carefully managing the political minefield that is out there, right? I mean, Brexit has had the positive side effect of actually strengthening the European Union. Was certainly not the intention of the Leavers, but the Leave campaign. But I think there is a risk here. I mean, we've seen the risk in the early 2010s. And as the last decade, I think that there's a risk again here. So I think combining the political narrative with the support, with the right reforms, I think it's well, you know, there's several balls that you have to keep in the air at the same time. So it's a tricky thing to do, and I don't have any I don't have any easy conclusions or easy recommendations here. But I think just keep trying. I think that's the best I can say. Thanks.
Thanks, Hans. First question, the last word to Vito Constancio.
Yes. Well, I share the skepticism of Luis about the reform components of this. Nevertheless, the bulk of the funds from the recovery fund has to be dedicated to greening and digital components. That's already positive if that broad orientation is complied with. Second point, the package, in my view, will only be used in what regards the grants component. In the end, no country will use the loans component, and that's what we see. So the package is smaller, almost half, a little less than half of the 750. Nevertheless, it will have a macroeconomic impact as it is spent and does not affect the deficit because it's grants. And then for the whole period until 26, this can lift GDP cumulatively to, say, 3%, 0.5 each year. That's the utmost we can expect. So it's not in the end a very big macro package, and will not help also very much the Capital Markets Union and the European safe asset. It's not big enough for that. So these in what regards the impact of this. So other reforms, I think, will not be achieved because of these recovery fund. And then I go back to the fiscal rules and the big threat that the fiscal policy from 23 onwards can become really too restrictive, and monetary policy will be under pressure, but the effectiveness of monetary policy in the present environment is not very, very significant. It can sustain, but it will not really be able to push up the economies, because we know from history that monetary policy is much more effective in restricting and fighting inflation than in fighting recessions, because just provided the liquidity, according to the famous story, we can take the donkey to the water, but we cannot force the imp to drink. So, and that's the plight where we are in the new macroeconomic environment in advanced economies. We need some help from fiscal policy.
So I think with those words, then we conclude.
Yeah.
So
not very,
very
not
nice
very
debate.
optimistic, but you know, that's also a sort of professional bias of economists.
Yes, I'm afraid that's the way.
especially central bankers, I could say.
Yeah, so we leave indeed more concerned than comforted, but still, it was a fascinating debate. So thank you very much, and
Thank you very much. Really an honor.
A bit longer.
Thank you.
I think now Luis Moraes would like to talk about the rest of the proceedings. On my part,
yes, thank you very much, and I thank you all. After a very vivid debate between key economists, the boring lawyer resumes with some housekeeping. But I thank you, and in the name of all the audience, because you gave us a very vivid picture of where we are, even if we are, quoting from Luis, politically stuck in key domains. But let's hope that we will soon be moving again somehow. Let's see in what direction. But I thank you all, because it was a very vivid and crucial debate. Just a note on housekeeping. We will have about 2 hours of break because everyone has tight agendas. So we will be resuming at 2:30 Lisbon time, 3:30 Brussels time, with an address by the Vice Governor of Bank of Portugal, Luís Máximo dos Santos, who will be commenting on the 2 pillars of banking supervision, market conduct and prudential supervision. And then we will conclude with the last panel reuniting Harold Benning and Michael Taylor, and as I mentioned a while ago, taking a wider look. So looking on the challenges to financial stability worldwide, confronting Europe, the United States, and East Asia, particularly China. Thank you all. Thank you, Pedro, too, as a long-time friend of CIRSF and this project, and we will resume in 2 hours' time. Thank you all. Muito boa tarde a todos. Boa tarde a todos. Se me permitem, vou passar ao inglês como língua oficial principal da conferência. Good afternoon, everyone, and welcome back to our afternoon sessions in the conference. And I think that we are indeed very fortunate to start the afternoon in the best way possible with, I'm sure, stimulating communication by the Vice Governor of the Bank of Portugal, Luís Máximo dos Santos, a publication entitled Safeguarding Banking Clients, an Integrated Approach of Banking Supervision, which will touch inevitably on the key critical issues of market conduct supervision, but also on the bridges between the pillar of market conduct supervision and prudential supervision. Allow me both an institutional and personal word to thank heartily Vice Governor Luís Máximo dos Santos for his presence and for his first-hour support and continuous support to our project of CIRSF under very difficult times. And I would like to make this word of appreciation a public word, marking his presence here in our conference and opening again in the best possible way the afternoon session. Vice Governor, the floor is yours.
Thank you very much, Luis. Good afternoon, everyone. Do you hear me well? Okay. Well, first of all, I would like to thank you for the invitation to take part in another annual conference of the Research Center on Regulation and Supervision of the Financial Sector. I would like to greet and congratulate Professor Luís Moraes for organizing another key event for the discussion of issues central to the current European financial system. And of course, I would also like to salute all participants and distinguished speakers. I believe I am voicing everyone's wishes if I say that, notwithstanding its success in this environment, we hope that this will be the last time we meet in an online format, and that in 2022, next year, the conditions will be right for us to get together in person. Of all the direct duties I have as Vice Governor of the Banco de Portugal, the topic I have chosen for my address here today is consumer protection in retail banking products and services. This is given that, for some time now, the topic seems to have become increasingly important and even more so in the current context of post-pandemic economic recovery. In last year's annual conference, I stressed that, unlike in other crises, the pandemic crisis have warranted a response that was strongly convergent and coordinated, both at European and national levels, but that it was far from clear what the profile of recovery would be. Happily today, the situation has turned out rather well, mostly due to the great success of the vaccine rollout in European countries, which has made it possible to gradually lift restrictions on mobility and economic activities, even for those most severely affected by the pandemic, as well as, of course, the magnitude, speed, and coordination of policy responses. Therefore, the main economic indicators are unambiguous about robust economic recovery in most European countries, including Portugal, and economic support programs financed by European funds are already on their way. Nevertheless, prudence, more than ever, should be one of the main virtues kept in mind of economic and political decision makers, particularly in terms of managing expectations. On the one hand, on a global scale, the results of the vaccination process are very asymmetrical, and as such, the possibility of new coronavirus variants emerging, especially in winter, cannot be ruled out, at least in the opinion of many experts. This could lead to possible restrictive measures hampering economic activities. On the other hand, the recovery towards 2019 domestic output levels remains constrained by many factors. Some vary from country to country, depending on the diversity of their productive structures, penalizing those countries whose sectors most affected by the pandemic account for a larger share of the economy, such as tourism. While other factors are more cross-cutting, such as the negative impact on industrial production of global supply chain problems, in particular with regard to semiconductors. This is demonstrated by the fact that in Portugal, for instance, the recovery in exports has been slower than in the euro area average, which is due to less favorable developments in exports in the service sector. Statistics Portugal has recently revised the value of the drop in Portuguese GDP in 2020, setting it at 8.4% instead of the 7.6% initially calculated. At the same time, it revised the economic growth in 2019 up from 2.5% to 2.7%. Therefore, the recovery of the Portuguese economy to pre-pandemic levels is no longer expected to materialize later this year. The deadline for the public moratorium applicable to most agreements ends today in Portugal, having been one of the key measures to protect households and firms from the effects of the economic crisis caused by the pandemic. It has been widely acknowledged that the Portuguese banking sector met the pandemic crisis at a much more capitalized level than in the previous crisis, having set out several years ago on a path in the right direction, with the purpose of consistently improving institutions' balance sheets. The greater resilience of the Portuguese banking sector was hard-won and bore various costs, including social costs. But this path had to be followed and is yet to be fully completed. However, The main economic and financial indicators currently available have set positive expectations about the withdrawal of the moratoria. Employment, for instance, has already exceeded pre-pandemic levels in Portugal, naturally with mixed developments across sectors of activity, but this is an extremely positive fact. Therefore, improvements in the economic outlook have become a reality, but we must not be under any illusion as to the difficulty and scale of the challenges ahead in terms of economic and social policy, particularly in heavily in-debt economies such as Portugal. The very positive developments I mentioned earlier in employment levels allow room for some optimism about the household's economic situation. However, we must remain highly vigilant as some economic effects of the crisis may take time to materialize and arise unexpectedly later on. So, robust arrangements to prevent non-performing loans are indispensable. In fact, financial consumer protection has become increasingly important, imperative even, in the context of the pandemic crisis. We must consider bank customer protection issues within an integrated view covering both supply and demand. The traditional focus on the transparent marketing of banking products, capacity building and qualification of institution staff presenting such products to customers, and the rigorous assessment of customer solvency are key, but they are not enough. The importance of promoting financial literacy in general and digital literacy in particular is another crucial dimension for the protection of bank customers, as it helps them make better and more informed decisions, reducing the likelihood of exposure to inappropriate risks and benefiting the entire financial system. The outbreak of the pandemic and its consequences have intensified two main pre-existing concerns. One, the importance of monitoring bank customers at risk of default or in arrears on credit agreements, and two, the intensification of the digital transformation process due to customers' increased use of digital channels. It is paramount that the action of banking conduct supervisory authorities is coherent and focused on all these dimensions to ensure that bank customers and the system itself are protected. Portugal has an arrears prevention and management model in place, established by a decree law published in 2012, based on two pillars: the pre-arrears action plan and the out-of-court arrears settlement procedure. This legal act introduced measures that were adopted later at European level, namely under the guidelines on arrears and foreclosure issued by the European Banking Authority in 2011. More recently, and anticipating the end of the moratoria, the legislator strengthened and improved the 2012 legislation by means of a decree law published in 6 August last month in order to ensure that the financial situation of customers covered by these support measures is closely monitored and to prevent them from defaulting on their credit agreements. Among the various amendments introduced by the mentioned decree law are: 1. Broadening the scope of the legal framework to include financial companies, payment institutions, and electronic money institutions. 2. Increasing the obligations that institutions must meet under the pre-arrears action plan and the out-of-court arrears settlement procedure. 3. Setting out an express provision for the obligation to report quantitative information to the Banco of Portugal. The legislator laid down a set of measures specifically aimed at borrowers with credit agreements covered by the moratoria in order to promote the prevention and settlement of arrears and, in some cases, establish time limits. It is primarily in the interests of the banks themselves, obviously, to have a policy in place to monitor their customers, identifying risk situations in a timely manner, and proposing mutually beneficial, tailor-made solutions to customers. Proximity to customers is essential to successful banking activity. However, although institutions always claim to follow this principle, this is not always the case. This is why we welcome the legislation published in August, which strengthens the legal methodology used to deal with preventing non-performing loans. The Bank of Portugal is also in the process of adopting a more intrusive model, implementing regulatory and supervisory changes to the measures adopted. This is the case of the introduction of an obligation to report quantitative information on credit agreements falling within the scope of the pre-arrears action plan as set out in the draft regulation that is under public consultation until next 21 October. As regards the increased use of digital channels by customers, the banking conduct supervision strategy is based on long-established pillars. To keep abreast of technological innovation, to monitor the offering of financial products and services, to remove regulatory barriers, to ensure technological neutrality, to promote digital financial education, and to punish breaches of the regulatory framework. Indeed, the Bank of Portugal recently issued best practice for institutions to observe when offering retail banking products and services through digital channels, namely bank deposits, credit products, payment services, and electronic money. In particular, these recommendations are intended: 1, to ensure that bank customers are provided with comprehensive and appropriate information on the product or service and their characteristics when purchasing through digital channels. 2, to enable institutions to know in advance the recommendations issued by the Bank of Portugal, facilitating their technological choices when offering retail bank products through digital channels. And finally, to make the monitoring of signing up processes through digital channels more timely and agile. In turn, the Bank of Portugal has been monitoring the digital financial inclusion of the Portuguese population and singled out the promotion of financial education as one of its priorities in its strategic plan for 2021-2025. Last week, the bank published the results of a survey of the population conducted at the start of 2020. Of course, in that conditions, we have not the impact of the pandemic situation, but the results demonstrate that they have clearly shown, the results clearly shown just how different the levels of the digital financial inclusion of the various age groups are, and confirm the challenges we face in order to prevent the risk of financial exclusion of certain demographic groups. The priority the bank is giving to promoting digital financial education was also confirmed a course of action that will have the support of the European Commission and the OECD over the coming months to establish a digital financial education strategy for Portugal. Following the shock and the rapid adaptation to the pandemic, all authorities are now faced with the difficult task of finding the right solutions to facilitate the evolution of the banking system, now that we are leaving behind both the pandemic and the more damaging effects of the crisis it has created. Thank you very much for your attention.
Thank you very much. I thank you, Martin, for a very comprehensive view about the market supervision and super protection, which is sometimes unduly overlooked. And I think that we got a lot of food for thought on key topics that you have emphasized. Thank you very much. Thank you very much for this intervention. I will ask everyone afterwards to bear with us for 10 minutes before we start the last panel of the conference with Harold Benning and Michael Taylor. Vice Governor, thank you very much.
Thank you very much, too.
And next year, physically, everyone here in Lisbon.
Yes, of course.
Thank you. Welcome back, everyone. We shall now proceed to the last section of our conference, in which we will try to address persistent challenges to financial stability worldwide in this context that many speakers have underlined today is still a context of uncertain recovery. And we shall try to confront the European situation, which has been the focus of our attention this morning, with the United States and Asia, and particularly China. We have for that an extremely good panel, at least I hope. I see that we have already my good friend Harold Benning. Harold is professor from Tilburg University, and is also the chair of the European Shadow Financial Committee, so in a very good position to give us a worldwide vision on the persistent challenges to financial stability worldwide. And I expect that any minute from now, Michael, who will be joining us from Singapore, so 11 p.m. there, I hope there will be no technical hurdle, might join us, but we are experiencing some problems in connecting with him. But for now, and even with more leeway, since we are still waiting for Michael, and we have this technical uncertainty, Harold, with my warm thanks for your participation in the conference, and only regretting that it's not a physical presence, but we hope we may amend that next year. The floor is yours.
Okay, thank you very much, Luis. Thank you for the invitation, and great to be part of this conference, which I have attended quite a few times. And it's always very much better to be in Lisbon than sitting at home using this technology, which seems to be working, but it's different. It's different than real life. Anyway, I think the timing of the conference is excellent in terms of what's happening on international financial markets. Of course, a couple of weeks ago, we were commemorating the fact that it was 13 years ago that Lehman Brothers went into bankruptcy, leading to a worldwide banking crisis, in particular, of course, in the United States and in Europe. The Lehman crisis and the rescue operations of banks in 2008, of course, this was a crisis which had to do with risky mortgage loans in the United States, subprime loans, but it created a confidence crisis on international financial markets. So in that sense, it's very interesting to make a comparison with what happened in China last week with Evergrande, where you see problems at a very important and large property developer being able to create a potential confidence crisis on world financial markets. Of course, it didn't happen in this case, because it seems to be that the Chinese authorities are most willing to stabilize the situation. They own parts of the financial system, so most likely this will not lead to a crisis at this moment. But I think the Evergrande crisis and the problems are highlighting the vulnerability of the global financial system. 2008, when we had Lehman, worldwide global debt ratio, so if you take the debt of governments, consumers and companies, was about 260% of world GDP. Well, 2008, we agreed that we called this the credit crisis, the great financial crisis, that we would have expected that this high debt ratio, global debt ratio, would be diminishing afterwards. But before Corona started, the global debt ratio had already increased to 320% of world GDP. And due to Corona, where governments have to, of course, obviously had to borrow a lot of money to finance and to the recovery and to stimulate their economies. What is very clear is that now the debt ratio is even higher. It's about 350% of global GDP. Part of this process has been driven by very accommodative monetary policy, interest rates close to zero. Look at the situation here in Europe, and the rate setting by the ECB, but of course also in the United States. The question is where this will end, because it's sometimes I make the comparison with blood pressure. So people can have a blood pressure of 160, no problem, then it moves to 180, 200, perhaps 220, but at some point the bubble may burst. And what we are seeing on a global scale is rising record high stock prices, record high real estate prices, record high debt levels, debt ratios. Look at Italy. Before Corona started, the Italian government debt ratio was already close to 135%. Now it's 160. So what you can say is that the fragility, the vulnerability of the global banking and financial system is rising rapidly. It doesn't mean that we automatically will be facing a financial crisis soon, but when I talk to people on financial markets and real estate investors, everyone is extremely concerned about the situation of these very high asset prices, low interest rates, and high debt levels. At some point, sooner than later, we may be heading towards a new financial crisis. And that is perhaps a sobering message when, for instance, I saw today that the Financial Times had on the front page, the Eurozone consumer activity returns to pre-pandemic levels. And that's good news, but the financial system is very fragile. And the point is, if we would be facing a new shock a la Lehman or Evergrande, and the shock would be substantial, and it would hit also the say the Eurozone, then we are in the Eurozone system, we are in sort of bad shape, because the government debt ratios are very high. Italy 160%, but countries like Spain and some other countries close to 120%. And the question is whether this such a shock, a confidence shock in the worldwide financial system, how this will affect the Euro system. Sorry. Now we have started new negotiations. New negotiations are starting about the Stability and Growth Pact, whether we should reinstate the rules of the 60% and 3%. But that seems to me like a surrealistic discussion, because quite a few countries, many countries, have not complied with these rules of the Stability and Growth Pact. The euro was created in 1999. How many years has, for instance, France, during the past 22 years, respected the 3% deficit rule? Not so many years. As concerns the 60% government debt ratio, how many years has Italy respected this ratio? Well, the answer is clear, 0 years. So my feeling is that now when the debate is starting again in Europe, whether we should reinstate the rules of the Stability of Growth Pact, that this is a bit of a surrealistic discussion, and it's not the real discussion to be pursued. An important element, I would say, of the real discussion is the sustainability of government debt. And one could have serious doubts about the sustainability of government debt in some countries in the Eurozone, notably Italy, but some others. We do know that if interest rates would be rising again to normal levels, say 4%, 3-4%, these countries would have huge problems in terms of debt sustainability. So in order to reduce the fragility of the Eurozone when there would be a new unexpected shocks from international financial markets, we need to start thinking about some way of risk sharing in the Eurozone, and not stick to the idea we have one single currency of 19 countries which have their own national budgetary policy and their own national sovereignty. Of course, the Corona Rescue Fund the Next Generation Fund, which was created last year by the European Union as a response to the corona crisis, is a very good start. But in case we are not willing to engage in some sort of risk sharing, and it can be different ways. It doesn't have to be Eurobonds. It could also be some sort of mutual guarantees on each other's government debt, and for instance, link it to credible programs of economic reforms. Could be many options. But my concern is that if we are not taking the lead and preparing the Eurozone, which is now in a weaker state than before Corona, and even before Corona, there were problems with some countries, that we may be hit when a new financial crisis, a new financial storm will be emerging. And then we'll be in bad shape, because then we'll have to take drastic rescue measures again. And then the question is whether there's sufficient political backing for that. And in that sense, it's also good to have a look at the situation in France and Italy, where right-wing populism is rising. In France, that's really related to what's happening in the banlieue, integration problems, but it's clearly to be seen that the party of Marine Le Pen is more popular, and some political observers in France are really worried that she may be a serious challenge to President Macron when France is having its elections in April, May next year. The same applies to Italy. Of course, now we have the benefit of the Prime Minister Mario Draghi, but if Draghi would step down at some point in time, for instance, when he would become president of Italy, the political landscape may change. And the right-wing populist parties, and I'm not only talking about the Lega, but also about the Italian Brotherhood, which also has about 20% in the polls, and of course the Forza Italia party of Berlusconi, they may become quite influential. And if a right-wing populist party would have an important role in the political process in either France or Italy, and the Eurozone would be hit by an unexpected shock on world financial markets, then it may be very difficult to implement certain rescue measures, because if these countries have anti-European oriented governments, that will make it difficult. So what we need to do, it's good that we have a type of Eurozone recovery, that we are coming out of the Corona crisis, that people are spending again. That's all very positive, but we must prepare. We should not close the eyes for the fact that the vulnerabilities in the global financial system have risen, and that a new financial crisis may be emerging sooner or later, because that will be affecting the Eurozone most likely. Thank you very much.
Thank you, Harold. We are definitely experiencing some problems with Michael, so I should have to act as a very poor replacement to Michael on some topics that I would like to raise. So allow me three topics, or to introduce three topics in our discussion. About the first one, feel free, since this was a point that I was considering basically to Michael, but I'm sure you may have a view on this, which is about and you've mentioned the case, which is about the Evergrande case. I take that you were somehow optimistic about the repercussions of the case, but there is a lot of discussion if this Evergrande case will not mark a turning point from the importance of real estate in the Chinese economy and the possible bubble that may be forming in the real estate market in China. So that would be the first point. The second point, address to your position as a great expert in the banking sector. And I'm bringing forward an issue which was very much discussed in the first panel of the conference in the morning, about profitability of European banks, about the real
structural problems of profitability of European banks. And I would like very much to have your critical take about the structural problem of profitability of banks. And the third point that I would like the liberty of raising, and I would like to have your critical take there also, has to do with a very recent development. I think there have been lots of comments about the conclusion of a conference that the ECB has held during the past 2 days on monetary policy. And yesterday, it was clear, apparently, more apparently than it is usual in a discussion between central bankers, that the US Central Bank and the Bank of England could be considering tightening a little bit monetary policy, whereas the European Central Bank and the Bank of Japan apparently are willing to keep a more expansionary line. Could we be in a moment of potential opposition between a bloc of Anglo-Saxon central banks and a different position on the part of the ECB and Bank of Japan? These would be the three questions that I would like to raise and to have your critical views on these issues.
Okay, thank you very much, Luis, for these questions and observations. Yeah, I think with Evergrande, of course, we know that with Lehman in 2008, it was the fact that the US authorities decided not to bail it out, not to rescue it, which then created this confidence crisis. And because the authorities thought, well, Lehman is an investment bank, is not a regular traditional bank focusing on loans to consumers and companies. But then it appeared that Lehman was much more connected to the traditional banking system than the authorities had anticipated. In China at the moment, I think that my feeling is that the Chinese authorities, they know, they are very much aware that if they let the things go out of hand, that may create a confidence crisis, a severe one. And I think they want to find a type of balance between not bailing out in all investors, but also not creating a financial crisis. And they seem to be powerful because they have a lot of influence on banks and other financial institutions. But that the whole process in China of the past 30 years or so, that 500 million or that 500 million people or so went from agriculture to the big cities and needed housing, and that the big cities were constructed and they were selling land for profitable prices and the property developers jumping on it, that process seems now to flatten out. It means that China can expect lower economic growth unless it can make new steps and bigger steps in terms of promoting and investing in sectors like high tech or greening sustainability. So China will be facing huge challenges. But if they would really let go the property market, then which I don't think they will, but if they would do it, that may be one of these big shocks for worldwide financial markets. And that would hit also Europe, also the banking system. There are two things here. First of all, as you know, with a couple of colleagues in the US and also in the European Shadow Financial Regulatory Committee, we've been working on the issue of bank capitalization for a long time. And when we had the crisis with Lehman in 2008, the capital ratios, and I'm talking here about the leverage ratio, the non-risk weighted capital ratio, for banks in Europe were historically low. They were in the range of, say, 5 to 6%. And in my country, for instance, the Netherlands, the big banks only had 2 or 3% equity. After Lehman, we have seen the Basel III Accord, the 2010 Accord, which has been an improvement because it has doubled, in my country, for instance, the level of capital from 3 to 6%. So that is, of course, positive. But historically speaking, it's still relatively low. In the early 1930s, banks still had a leverage ratio of 15% across Europe. And it's well known why this reduction in capital ratios was implemented and also accepted by bondholders and other unsecured creditors, that is because we introduced all types of guarantees in the banking system after the Great Depression in the 1930s of the past century. Deposit insurance, too big to fail, implicit guarantees. Meaning that part of the risk is not borne by the shareholders, but by the taxpayers. So if the banking system would be, if there would be a shock on worldwide financial markets, then the starting point of the banking system would still be very fragile, because bank capitalization is still, historically speaking, on the relatively low side. So that may create for the larger banks a confidence crisis, and that could create also the momentum that banks would have to be rescued again. Of course, we have the single resolution mechanism in Europe as part of banking union, but it's hard to see that if many systemically important banks in Europe in different countries would get in trouble at the same moment in time because of this shock on financial markets, that we would put all these banks into resolution, because that would most likely exacerbate the confidence crisis. So then we would have to bail them out. So the relatively low level of capitalization, notwithstanding the progress made since Lehman Brothers, is a matter of concern. And of course, then we have indeed, as you are pointing out, the fact that the profitability of banking in Europe tends to be lower on average than in the United States of America, which is also visible in the market to book ratio. So the market capitalization of equity of many banks in Europe is lower than the book value of equity. While in the US, it's the other way around, and that's what you would like to have, of course, that the market is valuing the assets of the bank at a higher price than the value of the assets on the balance sheet. And that has to do, of course, with all types of issues of lower profitability means cost structures, the lack of integration, the lack of that we need a consolidation in the European banking sector, which is, of course, which has been on the agenda for a long time, but it seems to be very difficult to figure out how to do it. And sometimes you see, for instance, that there were stories that sometimes a bank in one country wants to buy another bank, but there's a lot of opposition. So it's really not, the EU with 27 member states is a different thing than the United States of America, where consolidation is politically charged to a lesser extent. So, but at some point it will have to happen. But there, of course, there's the issue also that we still are missing the third pillar of banking union, the European Deposit Guarantee Scheme. And as long as we haven't cleaned up the balance sheets of the banks in Europe, the non-performing loans, then it will be, it's hard to see how the European Deposit Guarantee Scheme could be introduced. At least this is one of the objections of, for instance, countries like Germany. So indeed, the European banking sector is, for at least two reasons, not in such a good shape, relatively low level of capitalization, which makes it quite vulnerable when a new shock on global financial markets would emerge. And we know, we can predict, of course, we cannot predict in a sense this is going to happen next year or the year thereafter, but it seems to be likely. And a lot of investors on financial markets are talking about this, that this is not a stable equilibrium, what's happening on markets with these high valuations and high levels of debt. This will affect European banks if it's happening with the relatively low levels of capitalization, and they face the structural problem of relatively low profitability showing up in market to book values lower than 1. Now, then we have the interest rate policies that it seems to be that when I think about it, that for a country like the United States and the United Kingdom, it may be easier to implement increases of interest rates, because the Federal Reserve and the Bank of England are the central bank for one country. That was also, for instance, the case why it was also easier for the United States to implement certain measures after Lehman. But if you talk about the US Fed and the Bank of England, they can really look at the situation and the required monetary policy for their country. Of course, the European Central Bank is a central bank of 19 countries with very different situations in terms of economic competitiveness, the implementation of economic reforms, and notably government debt ratios. Like my country, the Netherlands, has been able to stay below the 60% government debt ratio, even with Corona. Well, the same applies to Germany and some other countries. But we have seen that the situation in notably France and other Southern European countries has become worse. So once the European Central Bank would consider to embark on a type of course, on a strategy of increasing interest rates, sooner than later we would be facing the issue of sustainability of government debt. And at some point, sooner than later, the European Central Bank would create its own crisis in the euro system. And that would be, of course, impossible to do, an impossible mission, because you cannot expect for the European Central Bank is the guardian of the euro, that the ECB would take actions in terms of putting the eurozone into danger. So, if we are not able, what I said during my presentation, if we are not able to solve this problem of government debt sustainability, there are different solutions, mutual guarantees, ways of partial debt restructuring. Then the only solution is, I guess, to keep interest rates low, even if inflation were to rise. Because the increase of the interest rates would lead to a situation where a new financial crisis, a confidence crisis with respect to the government debt of some Eurozone countries would be quite likely. So there's a catch-22. And the point is that last week, when there was now new discussions are starting about the Stability and Growth Pact, that there was a declaration of the ministers of finance of some of the frugal countries, of 8 frugal countries. They said, well, we want to stick to the norms, etc., etc. But if we are not able, if we stick to the current situation and we are not able to make progress with respect to debt sustainability, government debt sustainability, then the most likely the European Central Bank will have to maintain its strategy of buying up government bonds and keeping interest rates low. And then we will end up in a situation where every year a larger part of the Eurozone government debt is put on the balance sheet of the European Central Bank, which may also not be such a good or desirable thing, and may also lead to further tensions between northern countries and southern countries in the Eurozone. So we have at least two aspects in the Eurozone. There may be an unexpected shock on financial markets during the next years, which will affect the euro system and the banking system. And we are not really prepared for it. And on the other hand, at the political level, we are not seen not to be willing yet to take certain measures to enhance the stability of the Eurozone. That is, of course, not to say that this financial crisis will come during the next few years. It may not come, but in any case, what we can say as an economist, that we see all these signals that the vulnerability of the financial system, including in Europe, has been increasing substantially.
Thank you, Harold. I guess that we have now with us Michael Taylor. If you can connect your sound. Hello, Michael. If you can connect your micro. Well, let's see if Michael can connect the micro, because I'm seeing his image in the screen. But I would like to address the last question to Harald. So I think that we envisage that it will be difficult for the European Central Bank to embark on a divergent route from the Federal Reserve Board and the Bank of Japan. And of course, that will imply a bigger pressure on monetary policy. And then we have the issue of financial policy and the role, or an increased role of financial policy. And I guess that from your initial statement, you're quite skeptical about a review of the Stability Pact. We have now embarked on a potential process of review of the fiscal rules of the European Union. Vitor Constâncio this morning was a very strong advocate of a review of the Stability Pact. I take from your initial words that you were extremely skeptical about such review of the Stability Pact, but could I ask you briefly for your take on that point, Harald?
Well, I think, of course, I think it needs to be revised, but in a way, the question is, what is the focus? It seems that these, from the statement of these 8 frugal countries, including the Netherlands, Austria, Sweden, Denmark, Latvia, and so on, there's this focus. We want to stick to the rules, in particular the 3% and 60%. And my comment was, of course, well, it has not been credible because so many countries have not respected the rules for a long time. And it was actually Germany which broke the rules for the first time in 2004. But if the focus of the frugal countries is really on this 3% and 60%, that is, I think, a very different approach than the one we would like to see, is, of course, how you talk about how you can stimulate economic reforms, competitiveness, how you can enhance government debt, how you can enhance the sustainability of Eurozone debt in particular countries. And that would be the road I think that we should take. But from a political point, the starting point seems to be that quite a few of these northern countries seem to have a different emphasis, and that would explain a bit of my skepticism. Although I do not agree with the approach, I think we should take a much broader approach.
Thank you, Harald. I think that Michael is having, in fact, problems of sound. So I think that we will wrap up the session and move to the closing session. If hopefully Michael can resume and be 5 minutes with us, it would be good. But let's see how the technical issues can be addressed. So Harald, thank you very much for your insightful takes. We all have, I would say, mixed feelings. I think that the context now is a context in which we are moving towards economic recovery in Europe, but I think it's quite clear from all of us, as per your own words, that the banking sector has still certain fragilities, and an international financial shock, which cannot be entirely ruled out, would have serious repercussions for the European banking sector. Thanks a lot. I hope to see you again next year in Lisbon, then physically. Thank you, Harald.
Thank you, Luis.
Okay, we will move then to the closing session. If at any time, hopefully, Michael can get the sound, we will try still to get him aboard. But I would like now to initiate the closing session with Thomas Stedner, who is chairman of the Supervisory Board of the European Banking Institute, which is cooperating with us for several years. Paulo Vaz Freire, who is the director of Lisbon Law University, and José Miguel Almeida from CMVM for the closing session.
and possibly also afterwards some words also from someone from the Bank of Portugal. But for now, Thomas, I would give you the floor.
Thank you, Luis. Do you hear me and see me? Luis, do you hear me?
Okay, no, you're passing through.
Okay, good. Then, ladies and gentlemen and dear fellow colleagues, I'm delighted that the EBI was invited to participate at this conference as scientific partner like last year. And I think the conference proved to be a great success again. And first of all, I would like to thank Luis Moraes for organizing the conference and to the speakers for participating in the conference. The conference aimed to critically discuss the role of the financial sector in the post-COVID-19 European economic recovery and challenges ahead. Another question is regarding the emergence of new risks, which in the post-pandemic world will challenge the banking union and the capital market union. Overall, the European economy was struck in 2020 by the extraordinary and severe pandemic shock, with economic activity contracting sharply in the first half of the year. It recovered in the second half, albeit partially and unevenly across countries. Overall, the GDP fell by 6.6% compared to 2019. Both the economic outlook and the sentiment in the euro area, however, are brightening again. Despite growing COVID-19 incidence numbers, consumers and firms are becoming more upbeat about the future. The Commission's economic sentiment indicator has improved markedly since the beginning of the year and was near record highs in August. Consequently, in 2021 and 2022, GDP growth forecasts for the euro area have already been upgraded by roughly 0.6 percentage points compared to the previous projections. These improved economic prospects reflect the swifter progress of the vaccination campaign in the second quarter, substantial additional fiscal support, also partly funded by the Next Generation EU package, and a more favorable outlook for the global demand. Against this backdrop, euro area banks have weathered the pandemic crisis quite well. The deep recession certainly weighed on performance throughout last year, and macroeconomic conditions remained challenging in the first quarter of 2021 due to the third wave of the coronavirus infections. Yet, extraordinary fiscal and monetary policy support provided support to the economy over that period, including income support for firms and households, loan guarantees, and statutory payment moratoria, as well as the ECB's expanded set of unconventional monetary policy measures and prudential actions. These measures have been successful in helping the economy to absorb the shock of the coronavirus pandemic. Corporate insolvencies have been limited and the rise of unemployment contained. Sovereign debt markets have remained stable, and these policy actions have prevented adverse feedback loops between the real economy and the financial system. In stark contrast to the global financial crisis, banks actually have helped cushion the economic impact of the pandemic rather than exacerbate it. Bank capital and liquidity positions were much stronger at the onset of the pandemic than they were in 2008, bolstered in particular also by the regulatory reforms since 2008. The recent EBA stress test has further underlined the stronger resilience of the European banking sector. While bank valuations were hit hard in the initial phase of the crisis, in part from a significant drop in profitability, market sentiment has become more positive since late 2020. Bank equity prices relate on positive news about vaccines and rising reflation expectations, with investors anticipating that a steepening of the yield curve could support bank profitability. Nonetheless, despite growing market optimism, euro area banks still face important risks and continue to grapple with a long-run structural challenge to achieve a sustainable improvement in their profitability. Analysts expect euro area banks' return on equity to recover only gradually, reaching 6% by 2022. On average, this would still fall short of their cost of capital. Moreover, bank profitability in the euro area is expected to stay well behind that of large US banks, whose return on equity is currently projected to reach about 12% by 2022. I think looking beyond the challenges presented by the current crisis, addressing pre-existing structural weaknesses remains crucial to sustainably improve profitability. Profitability continues to be hampered by overcapacity. Banks continue to operate in a competitive environment with revenues under pressure not just from their peers, but also from new entrants from outside the sector, such as fintech companies. Banks need to speed up their digital transformation, a process that requires substantial investment, but has the potential to deliver both cost savings and higher revenues. In today's conference, many different topics on the wider field of banking have been addressed: the state of the banking union and the capital market union project, reform of economic governance in the monetary union, and challenges to financial stability. I'm sure that this conference brought you a lot of interesting insights into all of these issues, and I hope we see you again at next year's conference. These words, Luis, in the name of the EBI, a big thank you to you and the organizers for hosting this conference again. I think it was a big success. Back to you, Luis.
Thank you, Thomas. It's always a pleasure to cooperate with EBI. I shall make a last attempt to connect Michael, if he can get the sound. Michael, can you connect your micro?
Does this work? Can you hear me?
Yes.
Yeah.
Yes.
Okay, well, my deepest apologies. I'm not really clear in terms of what's happened, but there was obviously some confusion over time difference. I was actually expecting to speak at 11 p.m. my time, and it's not quite 11 p.m. yet. However, I don't know, Luis, whether you would like me to say a few words now, or whether you would just like to go ahead
Michael,
with the conclusion.
If you can, and it's a big challenge to have a digital conversation between Lisbon and Singapore with a large time difference. And if we have flexibility from the other participants in the closing session, Paula Vacheira and José Miguel Almeida, if you can very briefly give us your take about possible tensions that may be forming in China's financial system. We have addressed, both myself and Harold, the recent Evergrande case, but of course without your insight about the potential repercussions of this Evergrande case. So if it is at all feasible or reasonable for you to have your take on this, it will be very much appreciated.
Yes, certainly. I'm very happy to do so. I think for people in the Asia Pacific region, Evergrande has not been such a big surprise as it has been maybe in other parts of the world. I mean, we've been following the evolution of the problems in Evergrande for some time. And certainly from June of this year, it was quite clear that this property developer was in very serious trouble. Now, the issue is this is obviously a property development company. It's a very large property development company, and it has substantial liabilities. The Chinese government has been attempting to reduce the speculative activity in the real estate market for some time, and has brought in a series of measures. And some of them have been directly aimed at the leverage of property developers. It's a policy known as the three red lines, which concerns the structure of borrowing by the property developers. Evergrande is unique in this respect, in that it violated all of the three red lines, each of the three red lines. So it violated Chinese government policy as far as its leverage was concerned. It has attempted, since that policy was introduced last year, to reduce its leverage, to pay down some of its borrowing. But what it has done, in effect, is to reduce its borrowing, but then the structure of its liabilities have changed. And if you look at the structure of its liabilities, its payments that it owes to its contractors have increased very substantially. So it's effectively been funding itself through two main channels. One is the prepayment that purchasers of apartments make to property developers in China. Basically, the way it works is that you pay in advance for the apartment and then the property developer constructs it. And the other way in which it's funded itself in recent months, essentially going back to the end of last year, is that the payments that it owes its contractors have also increased very substantially. And because of its size in the market, it's been able to squeeze longer and longer repayment periods from its contractors. So it's essentially a very large, very over-leveraged property development company that has been increasingly relying on short-term borrowing. And to the extent that it has borrowed from the banking system, and it has substantial borrowings from the Chinese banking system, those borrowings have become increasingly short-term. So what has happened is that the company has experienced a very significant liquidity problem, essentially because it's lost access to funding markets, and its ability to rely on these other funding sources have become has become quite limited now. So then the question is, what is the impact on China's financial system? And I've read quite a lot of commentary over the last few weeks where people, commentators, particularly those from outside of China and outside of the Asia Pacific region, have talked about what they call China's Lehman moment. The implication being that Evergrande represents the same kind of systemic risk that Lehman Brothers did in effectively the trigger for the global financial crisis. Now, I think that is a very misguided way of looking at the problem. Yes, Evergrande is very large. It has large borrowings. Those borrowings are relatively short term, but it is a property developer. It isn't a bank. The bank borrowings are very widely diversified across a large part of the Chinese banking system. The large Chinese banks have the ability to absorb whatever losses may result from Evergrande without it substantially eroding their capital buffers. So I think from the point of view of, is this a risk to financial stability in any kind of direct sense, I think that is very unlikely. There is another transmission channel, which is through the property market. And the property market is a very significant part of China's economy. The real estate market by itself represents about 7% of GDP. But then if you add in all of the industries that are related to real estate, such as construction, steel, cement, heavy machinery, it becomes about 25% of GDP. So I often compare the property market in China to a bullwhip, the handle of a whip. You can get very small changes in the property market, which then have very substantial impact down the supply chain. And we've seen in previous cycles that the Chinese government, in attempting to control the property market, has effectively reduced economic growth, sometimes quite significantly. And what happens as a result of that is then that the market cooling measures that they've taken, they then start to ease up on, so that GDP growth picks up again. So I think the biggest risk of Evergrande for China is not a financial system risk. It's effectively a real economy risk. It's GDP growth, and the fact that China's economy could slow down quite substantially if there is a major spillover effect into the property market. Now, there are reasons for thinking that that is not likely to happen. First of all, the slowdown in China's property market is a result of direct government policy, and that policy can be changed very, very quickly. They can remove some of these constraints that they've placed on the financing of property developers. They can remove some of the constraints they've placed on mortgage financing. So in that respect, they do have the ability to ease up on some of these restrictive measures. Chinese government also has room to cut interest rates further. Monetary policy at the moment is neutral, so there is room for further monetary policy easing. There is room for further fiscal policy support to China's economy. So I think if we start to see a big slowdown in terms of China's economy as a result of spillovers from Evergrande, the Chinese government will respond to that and will try to maintain a reasonable level of economic growth. So there are certainly risks there, and unfortunately, because we're running out of time, I can't go into detail in terms of where some of the downside risks are. But I think overall, if you look at some of the commentary that has been around over the last couple of weeks, it is rather alarmist in terms of the way in which commentators are talking about Evergrande. Yes, it is a big, indebted, highly leveraged property company, but it does not pose a systemic risk within China. That's as condensed as I can make the message, Luis. I mean, if we have had more time, and unfortunately, it's unfortunate that I can't spend a bit more time on this topic, but that was basically my message.
Thank you very much, Michael. But I think it was worth for us to try to overcome this technological adventure of connecting Singapore with Lisbon and bridging more than 10 hours of difference. I thank you a lot because we got a very insightful view about the potential repercussions of this Evergrande case, and at least in part, somehow reassuring view, cutting short more alarmist views on this significant case. Thank you very much. And it's almost unconstitutional to have you participating at so late an hour in Singapore, but I thank you heartily for your presence. And then we will then resume the closing session. I think that if we have Paulo Rashfred with us, I think so, I would give her the floor, and then to José Miguel Almeida. So, Paula.
Hello. Thank you very much, Luis. Are you listening to me?
Yes, you're getting through.
First of all, on behalf of the Faculty of Law, I want to say that I'm very pleased to be here in this annual conference of the Centro de Investigação sobre Regulação e Supervisão Financeira. I would like to address and salute, in first place, Luís Moraes, who is, as you all know, responsible for organizing this event in a unique way, because he can join, he has all these dynamic in him, and he is always able to join brilliant participants in these conferences that he organizes. Luis, thank you very much. I know it's always an enormous effort for you, but it is worthwhile. Also, allow me to salute José Miguel Almeida and CMVM, a partner in these events, and stress that for the Faculty of Law, it is an honor to be once more a partner in the conferences that are held by the Investigation Center. An event which has particular features because it is a gathering of national regulators of financial markets, European regulators, and also the academy, also the university. Universities have a look and a contribution very relevant to give. This year, it was still not possible to have this event in person. Let's hope that next year we'll be all together. But what really matters is that this reunion works as a reflection, a way of thinking and rethinking the way the financial system can help the recovery of the economy in Europe, especially in Europe, but also all over the world. The last year and a half has shown us how an exogenous event, and I call it exogenous in a not very correct sense, but in the sense that it was something that was not strictly economic or financial in that sense. Well, I was saying that this event, this pandemic crisis that affected our way of life, of living, taught us that nothing is, we can take nothing for granted, and everything has to be seen in a different perspective. It also, this context poses also enormous challenges and answers for new problems, or problems that were old but affect us now with a different magnitude. And therefore, institutions are more relevant than ever, and the way they are sound robust, but also the way they adjust are determinant for the safety of the citizens, for the way the states work and the economies work, and for economic international relations. Therefore, thinking and rethinking governance in financial markets in the European Union, especially regarding banking union and also the European Union of capitals markets, is very relevant, and of course you have discussed this the whole day, and are under pressure from all these challenges. But I know that all present here know that these institutions and European institutions, national and European institutions, will be able to respond to the challenges, and that will contribute, of course, for the welfare of the European citizens. Thank you for your attention, and Luis, thank you very much for organizing these events. Thank you.
Thank you, Paula Mastroianni. Thank you very much for your kind words. It's always a pleasure to promote this interaction between our university, EBI, other stakeholders, and financial supervisors. And speaking about financial supervisors, thanking him for his flexibility, because we had this technical incident concerning the participation of Michael Taylor. I will give the floor to José Miguel Almeida on behalf of CMVM.
Luís Moraes, muito obrigado, muito boa tarde a todos. Good afternoon. It is a pleasure to be here and to have the privilege of saying some final words on this very interesting conference, as usual. The speakers fed us with very rich ideas that will feed our own reflections and future work. I would like to start by pointing out an idea shared by several speakers. The financial system showed resilience during the pandemic shock, and this is something made possible by the work done and lessons learned since the last crisis. A very interesting idea was introduced by Luís Moraes, portraying the present EU situation as a triangle. The first side relates to the need to reform the fiscal European rules. This will generate most probably a fierce debate between flexibility supporters and more conservative positions. On the second side, the need to complete the banking union was stressed, an idea that Governor Mário Centeno also stressed and that will require strong political commitment. The third side of the triangle relates to the complexion of the CMU In respect to this point, Gabriel Figueiredo Dias stressed the need to affirm the role of capital market as a viable and attractive alternative source of funding to the real economy, and stressed that this could be a refundational moment for capital markets in Europe, boosting a capital market union that places retail investors at its core. However, some risks persist and vulnerabilities need to be addressed, such as asset quality and valuation, rise of indebtedness, and unemployment. In order to address these challenges, it was proposed to keep close monitoring and standing ready to use flexibility and a steady hand. This continuous effort will probably render true the assertion that there will be no permanent losses arising from this crisis. It was also highlighted that Europe was able to move from a coordinated austerity to a coordinated support, resulting in a more favorable context for recovery. And the opportunities to grow in a more digital, resilient, and sustainable way cannot be missed. The first panel underlined an idea that was put forward right in the opening remark. This is not the time to stand still. We need to address risks that crisis made visible and to tackle challenges ahead of us. Amongst the challenge, a better quality of capital was underlined, as well as the role of capital markets in these aspects. Regarding the banking sector, it was stressed that this time it was part of the solution of the crisis and not the cause of the crisis. However, banks still face some challenges that were commonly pointed out. Profitability in a low interest rate environment with non-performing assets expected to rise after the support measures are lifted, and so on. Digitalization can play an important role in terms of cost efficiency, but also brings new and complex risks, as well as challenges for the incumbent entities. The shift to the sustainability agenda and effective integration across the European Union. The need for completing the banking union and capital market union was highly stressed. With regard to CMU, three main tasks were underlined, retail participation being the first. Higher participation will need to be based on retail protection. Therefore, retail participation cannot be achieved without measures that increment trust as confidence remains low. The need to promote access of PME to capital markets was another point of much interest. Finally, an harmonized EU legislation is considered an important step forward towards CMU and to ensure supervisory convergence. However, on a complementary perspective, it was underlined that this convergence must be pursued with the tools already in place, which were reinforced with the revision of the ESA's framework. The main message from this panel was probably cautious optimism and the urgency to advance on the needed reforms. The second panel was dominated by economists and their vision on the challenges ahead. An important statement was that, like Gabriel Figueiredo Dias said in the beginning, the EU financial and particularly banking sector is still in a cloud of uncertainty. Concerns were expressed relating to possible increasing on non-performing assets, corporate fragility, a return to fiscal austerity, tone being set by Germany, financial dominance, and continuation on credit restrictions and moral hazard originating from support measures. A call was made to supervisors to address these risks that are detrimental to recovery. Fiscal policy must also assume its role in financial stability. Again, the need to advance in financial reforms agenda was stressed. The banking union seems to be stuck, and a very expressive sentence was heard. The hybrid Rolls-Royce is in the garage. The adoption of the deposits insurance mechanism is one of the main concerns. Another relevant concern that emerged in this is the liquidity mismatch in investment funds. This topic, and not in investment funds, the case of Evergrande seems to be also another case, and it was pointed out a few minutes ago. This topic was not much discussed, but I take the opportunity to say that this is a concern that at European level, securities regulators, ESMA and ESRB, as well as European Commission are working on, and regulatory changes as well as supervisory efforts are currently underway to tackle this important issue. In the afternoon, we were told that prudence should be one of the main virtues to keep in mind by policy decision makers, namely in terms of expectations. As a result of vaccines are not completely clear, we may still need additional restrictive measures. Another important idea that emerged in the discussion is the importance of promoting financial literacy in general and digital literacy in particular, to help investors make better and informed decisions benefiting the entire financial system. The only possible way to call for investment from investors is through financial literacy. I will add that companies' literacy in both aspects also needs to be targeted, particularly in countries with a very large percentage of SMEs. In a less optimistic tone, the fragility of the European banking sector was pointed out, due mainly to low profitability and capitalization. In case of a new substantial shock, the Eurozone system would probably not react well. Therefore, it was sustained that we need to address risk in the Eurozone carefully. The government debt sustainability was identified as one of the main challenges linking to low interest rates and inflation. Unless it is properly addressed, it may represent a vulnerability with impact in a future crisis. However, a broader approach was supported with a view to foster European competitiveness. In all these situations, financial markets must be a way forward to tackle many of European problems, not only in European Union, but also in Portugal. I am sure these reflections will remain in our thoughts for a while. Thank you very much for the attention. Luis, thank you very much for this success again in stepping up this conference. Thank you very much. Good afternoon.
Thank you very much, Miguel Almeida. And you allow me to finish very briefly because you did a brilliant summary of the content of our proceedings today. So I double thank to you for this intervention. So I will be very brief in these final remarks. There is a big digital fatigue about the conference starting at 9 o'clock Portuguese time, 10 o'clock Brussels time. I think that José Miguel Almeida has very vividly pointed out the main topics that we have covered during the various sessions. I would like to end emphasizing again with an invitation for next year conference that as I've stated in the beginning, 2022 will really be a crucial year in terms of new developments, both in terms of a potential review of fiscal policy oriented towards financial stability in spite of the skepticism that we may have about policy divergences as regards the content of a review of fiscal policy in the European Union, and both as regards potential developments in terms of the banking union and the capital markets union. José Miguel Almeida just recalled a very suggestive expression that was coined, I think, by Luis Garicano by the end of the morning, when he mentioned pointedly about banking union that we had the Rolls-Royce in the garage and we needed to see if we could get this Rolls-Royce out of the garage
which is an excellent topic for debate next year, I hope, in a physical conference here in Lisbon, to which you are all invited. But I would not like to conclude without thanking our scientific partners, particularly the ones which are represented here in this closing session, starting with our partners this year, the Portuguese Financial Supervisory Authorities, in the persons of Mário Centeno and Luís Máximo, who have intervened in the morning and in the beginning of the afternoon, and through the persons of Gabriela Figueiredo Dias and José Miguel Almeida now at the closing session. By the way, my best goes for the big CMVM conference at the beginning of November, which I'm sure will also be a success. And a final word to thank Thomas Gstebner and EBI for our intense cooperation, which I'm sure will intensify in the coming year. And I could not finish without a final word to my alma mater, the law faculty of the University of Lisbon, which of course is at the core of this organization. But it's time to conclude. Thank you for your attention, and I hope that the proceedings during the day were productive, and hope to see you again physically in Lisbon next year. Thank you all, and good afternoon.
Goodbye.
Bye.
Bye-bye.
Bye.